analysis. Then in subtopic number 4, we will discuss the evaluation of financing options. Then lastly, there is the methods of issuing ordinary shares. We look at the public issue, the private placement, bonus issue, employee stock option plans, and rights issue. So that is what is expected of you as far as the chapter on the financing decision is concerned. And before we get into the objectives of the financing decisions, I'm going to make a few comments about the financing decisions. Now, candidates, the financing decisions are decisions regarding the methods that are used to raise funds which would be used for making acquisitions. The financing decisions are decisions concerning the liabilities and also the stockholders' equity side of the firm's balance sheet, such as decision to issue bonds. When looking at the financing decisions, candidates, we are considering the right-hand side of the balance sheet, which comprise the capital and also the liabilities. By now, I'm sure you know that there are two sides to a balance sheet, the debit side and the credit side. Under financing decisions, we'll be considering the items that appear on the credit side of the balance sheet. So the financing decisions, candidates, involve various factors, and they are the expenditure analysis. They involve raising funds on the most favorable terms possible, and also managing the working capital, such as the inventory, the accounts receivable, and so on. So a finance manager is expected to help the company to raise funds on the most favorable terms possible. And the goals of corporate finance candidates can be achieved only when the corporate investment is financed appropriately. And there has to be what we call the financing mix. Why? Because the financing mix will make an impact on the valuation. And the company should therefore identify what we call an optimal mix of financing. All right? That means the one which results in maximum value. So the finance manager is expected to help the company come up with an optimal mix of financing. For example, if a project is to be financed, the finance manager should be able to tell what will be the proportion of money that will be raised out of debt, what will be the proportion that will be raised out of capital, share capital, and so on. Why? So that the goals of corporate finance can be achieved. And that goal can only be achieved when there is a financing mix, when the results lead to what we call maximum value. And candidates, the sources of finance are usually comprised of combination of debt and equity financing. And we all know that a project that is financed through debt results in a liability and obligation. If a project is to be raised through debt, then that debt will result into a liability and an obligation. And when a project is financed through equity, it is less risky. It is what? It is less risky with respect to cash flow commitments. When a company raises money through equity, then that company does not have to be servicing loans every month. All right? So the cost of equity is always higher than the cost of debt. the equity candidates financing may result in what we also call an increased hurdle rate. So the management of the company must match the financing mix to the asset that is being financed. And one of the theories as to how the firm makes their financing decisions is the pecking order theory. The pecking order theory. Pecking order theory. This is one of the theories. And what is the pecking order theory all about? Candidates, under this theory, under the pecking order theory, the firm should avoid external financing if it has availability of internally generated funds. Pecking order. The firm should avoid external financing like debt if the firm can make use of, say, retained earnings, internally generated financing. If the firm can raise money internally under pecking order, the firm should avoid external financing. The firm also, candidates, should avoid equity financing if they have an option of debt financing which is lower, okay, which has a lower interest rate. If a firm has a lower, can raise debt at a lower interest rate, the firm should go for debt financing if the interest rate is lower. I also mentioned that under pecking order, a firm should opt for internal sources. If the firm has internal sources of finance like retained earnings, then the firm should exhaust the internal sources before the external, because generally the external sources of funds is cheaper than the external sources. So the pecking order is one of the theories that can help a finance manager make the financing decisions. And another theory which can help a finance manager to make financing decisions is what we call the trade-off theory. The trade-off. Trade-off theory. What is this theory all about? Now, the trade-off theory is where firms are assumed to trade off what we call tax benefits. They assume to do what? To trade off tax benefits with what we call the bankruptcy costs. Bankruptcy. The firm can do what? Can trade off the tax benefits with bankruptcy costs when making financing decisions. Bankruptcy costs. Now, having made the few comments on the financing decisions, let's now move to study the nature and objectives of financing decision. Nature and objectives of the financing decision. Now, candidates, the nature of financial decisions vary from one firm to the other. And it may be also different for the same firm over a period of time. It may also be what? Different for the same nature of farms over a period of time. So it's important to note that the nature of financial decisions vary from one farm to the other. And even the farms which may seem the same, the nature of financial decisions can also vary over time. And the reason is that the nature of financial decisions is influenced by prevailing microeconomics and macro conditions. Macro and micro conditions. The what? The reason why the nature of financial decisions vary from one farm to the other is that the nature of financial decisions is done what? Is influenced by the prevailing microeconomic and macroeconomic conditions. Macro and micro. Microeconomic and macroeconomic conditions or factors. Microeconomic conditions, macroeconomic conditions. Now let's try and understand microeconomic conditions. Now, candidates, microeconomic conditions or factors are factors that are related or conditions that are related to the internal conditions of the farm. Microeconomic conditions are the factors that are related to the internal conditions of the farm. Internal conditions of the farm. Now, the important among these conditions, these are the internal conditions. One of the internal conditions is the nature and size of the farm. One, nature and size of the farm. The nature and the size of the farm. The nature and the size, because we have small farms, we have large farms, we have private farms that are run by families, we have farms that are incorporated. So the nature and the size of the farm is an internal condition that will determine the financing decision that will influence the internal or the financing decisions of the farm. The nature and the size of the farm. 2, the level of risk. The level of risk. And this can be established or determined by looking at the stability of earnings. Let me just put and stability of earnings. There are farms whose earnings are stable. There are farms whose earnings are not stable, not predictable. So the level of risk and stability of a farm is an internal condition, Number 3, liquidity. The liquidity position the liquidity position. There are firms that are liquid, there are those that are not liquid. Asset structure, number 4. Asset structure is an internal condition. Asset structure. The asset structure of a firm is also an internal condition. The asset structure of the firm, the asset structure of the firm, as well as the pattern of ownership and the pattern of ownership. Asset structure and pattern of ownership is an internal condition which may influence financing decisions, Another internal condition or factor is the attitude of management. The attitude of management. The attitude of management. So let's discuss some of these microeconomic conditions in brief, starting with the nature and size of the firm. How is the nature and size of the firm? How does the nature and size of the firm influence financing decisions? Now, candidates, if a firm is engaged, for example, in manufacturing operations or in the provision of public utility services, its investment in fixed assets is large, and hence the capital structure has a large share of long-term capital. And the share, candidates, the share of long-term capital in the capital structure will also be large in firms that produce capital goods. On the other hand, in trading companies or concerns, a greater part of the investment is found in current assets. I'll give an example of a supermarket. A supermarket is most likely to have a larger part of its investment in stock, as opposed to, say, Toyota company, which engages in production of capital goods. So the investment of Toyota in fixed assets will be larger, and therefore the capital structure will have a larger share of long-term capital. But in trading concerns or companies who buy finished goods and sell finished goods. Those are trading concerns. They do not manufacture. So you'll find that the greater part of the investment is found in current assets. And with a greater ratio of current assets, the ratio of current liabilities also rises. And similarly, companies that are larger in size need larger capital. We are discussing size. We discuss the nature by looking at the nature. The nature could be, say, a manufacturing firm and a trading firm. That's the nature. Size, we have a small company and a large company. Companies that are large in size, companies that have, say, 1,000 employees, will need large capital. Even just working capital, paying salaries, paying rent, paying for office space, see, that will require large capital as compared to a small firm of, say, 5 employees. All right, a firm that has just 5 employees, that's a company that do not need large amounts of capital. Small firms may obtain their fixed assets just, say, on lease or hire, but large firms would need to construct their own buildings. They may need to assemble their own plants and so on. So small companies will have lower goodwill in the capital market. And so their financing decisions are different from that of larger firms. Larger firms will find them trading in stock exchanges and so on. And it is because of the lack of sufficient goodwill in the capital market that small firms are largely dependent on internal finances. And that is one of the reasons that their dividend decisions are different from that of large organizations. The dividend decision candidates, as we'll be studying later on, is also dependent on the earnings of a company. A company that relies on internal sources will have a different dividend policy from a company that gets its sources from, say, the capital market. Because if a firm gets its sources through maybe shares, then such a company is obligated to pay dividends to shareholders. But if a firm has generated these funds internally, then you see that company's dividend decision may be different. So you can see how the nature and the size of a firm, you can see how it affects or influences financing decisions. Then there is a level of risk and stability of earnings. Level of risk and stability of earnings. Candidate risk is another important factor influencing financing decisions, because the greater the risk, the higher the discount factor. And therefore, risk influences the long-term investment decision or capital budgeting decision. Again, if risk is higher or if income is not stable, risk being higher means unstable income, then the finance manager tries to impress the shareholders for more retention of earnings rather than adopting a liberal dividend policy. But with stable income, with stable income or lower risk, because a company that has a stable income is a company that has a lower risk. So if the income is stable, in other words, if the risk is lower, the financial decision will be just the reverse. And in such a case, the fixed cost capital such as the preference shares and debentures may be preferred. All right? If a company has stable income, then that company can easily service loans, can easily pay interest on debentures, can pay fixed dividends to preferred shareholders and so on. So you can see how level of risk influences financing decisions. A company that has unstable income is a high-risk company because of the instability in earnings. Such a company cannot easily raise money through loans or debt. And the management may go for, say, internal sources. And if a company relies on the internal sources, that means that the shareholders may not be paid, because shareholders are paid out of earnings. If they are not paid dividends, then it means the money is being retained. So the dividend policy of such a company will be different from a company that has stable income. A company that has stable income can easily get sources from external sources, from debentures, from preference shares, from loans, and so on. Do you understand how the level of risk and stability of earnings influence financing decision? If you don't worry. If you don't understand what I'm talking about here, don't worry, because we shall be repeating what I'm talking here when we be discussing dividend policy decisions. We'll also talk about it when discussing capital budgeting decisions. So let us proceed to the third factor. We are discussing microeconomic conditions that are related to the internal conditions of a firm that influence financing decisions. Number 3, we have liquidity position. Liquidity position. This is the third factor that influences the financing decisions. And candidates, since dividend is normally paid out of cash, firms with a sound liquidity position adopt what we call a liberal dividend policy. But if in such cases the working capital requirements are very large, or the firm has to meet significant past obligations, then it will have to follow a conservative dividend policy. Conservative dividend policy. What do I mean? What do I mean when I say a firm having a sound liquidity position? A firm that has a sound liquidity position is a firm that has at its disposal cash. Liquid is just money. A company that has financial resources that are in monetary terms. That's a firm that is liquid. You may find a firm that is more liquid, another one is not liquid. Not liquid means a firm that does not have sufficient money or financial resources to meet its short-term obligations. A firm that is unable to meet its short-term obligations is a firm that we can be described as having what we call unsound liquidity position. A firm that has at its disposal sufficient money to meet its short-term obligations is a firm that has a sound liquidity position. Do you understand, candidates? So, candidates, because dividends are normally paid out of cash, firms with sound liquidity position can adopt a liberal dividend policy. Liberal dividend policy means that a firm that distributes its earnings to the shareholders in form of dividends. Liberal, easily pays out of earnings, pays dividends. A firm that adopts a conservative dividend policy is a firm that instead of paying dividends, the firm uses these earnings to finance its obligations. All right? The working capital requirements. If the working capital requirements are very large, working capital requirements would relate to things like payment of salaries, payment of maybe trade receivables, paying debtors, paying the day-to-day expenses, buying inventories, raw materials. Those are working capital requirements. If the working capital requirements are very large, then a firm may adopt a conservative dividend policy. A firm will choose not to pay dividends. That means a firm will use this, the little cash at its own disposal to finance. Remember, we are talking about financing decisions. And this financing decision would also relate to financing of the working capital requirements. So the liquidity position of an organization can influence the financial decisions. Then moving on to the fourth internal condition, or what we are calling the microeconomic condition, is the asset structure and pattern of ownership. Again, candidates, in a closely held company where the ownership is in few hands, the management does not find it difficult to persuade the owners to accept a conservative dividend policy. Now, I'm repeating, candidates, a conservative dividend policy is a policy where the company chooses not to pay dividends to the shareholders, but retains the money for financing of the projects of the company. A company that adopts a conservative dividend policy is a company that chooses to use the internal sources of finance to finance its projects instead of paying dividends. So if pattern of structure, we're talking about pattern of structure. If a company ownership is in few hands, if it's owned by, say, 2 people or 1 person, then it becomes easy for management to convince this 1 person to hold on until the company's finances are stable, to hold on until the company can maybe have enough cash to pay earnings. It's very easy to persuade a small group of people to accept a conservative dividend policy in the interest of the firm. But in cases where there are many shareholders, where there are many shareholders, 1,000 shareholders, then their wishes also matter considerably. It's not easy to convince 2,000 people to hold on. It's not easy to convince such a large number of owners to accept a conservative dividend policy, because these many owners have varying needs. They have varying wishes, and their wishes matter considerably. So the asset structure and the pattern of ownership influences financing decisions. Then lastly, there is the attitude of management. Now, how does attitude of management influence financing decisions? Attitude of management. Here we are referring to the attitude of management in relation to things like risk. Now, a conservative finance manager will attach greater importance to liquidity rather than to profitability. On the other hand, an aggressive finance manager will stress on profitability and not liquidity. A conservative finance manager is one who does not take higher risks, because to attain high profitability, then it means that one has to engage in risky projects, to undertake risky projects. That's kind of endeavors are not pursued by conservative finance managers. Conservative finance managers would rather go for liquidity, holding cash rather than investing in risky projects. But an aggressive manager would go for risky projects in order to attain high profitability. For example, a conservative manager attempts to tread on what we call a beaten path. That's a conservative manager. Will not go into new ventures, risky projects, no. Such a manager will prefer to avoid the fixed obligations for raising additional capital. Even when debt is advantageous, such a manager will shy away from debt. And the preference is to maintain a large volume of current assets. All right? A large volume of what? Current assets. But an aggressive finance manager is one who is ready to bear risk that is involved in debt financing. Because for a company to undertake new risky projects, then a company may need to raise money, and that money may have to be raised through debt. So you may find such a manager getting involved in debt financing and or involving himself in having low current assets. But we can say here that a prudent manager is one who would prefer a compromise between risk and return, or between profitability and liquidity. So the attitude of the manager can also influence the kind of financing decisions that are taken in a company. Do you understand? There are managers who are aggressive, that is an attitude. There are managers who are conservative, that's an attitude. So a conservative manager will prefer holding current assets, holding cash, maintaining high current assets. An aggressive manager is one who may go for risky projects in order to attain high profitability for the company. So you can see that the attitude can influence the kind of financing decisions that are made in a company. So candidates, that will bring this lesson to an end. We just introduced the financing decision. And at the beginning, I mentioned that the financing decision is one of the crucial decisions that are made by financial managers. If you are a finance manager, then one of the main roles that you will play is helping the company make the financing decision. And we've, in today's lesson, introduced the subtopic on the nature and objectives of financing decisions. We've said that financing decisions can be influenced by microeconomic conditions and macroeconomic conditions. In today's lesson, we discussed the microeconomic conditions that affect or influence financing decisions. We discussed 5 factors. The first one is nature and size of the firm. Number 2, the level of risk and stability of earnings. Number 3, liquidity position. Number 4, asset structure and pattern of ownership. Then lastly, the attitude of management. I'll leave you with an assignment. Discuss 5 microeconomic factors that may influence the financing decision of a firm. I repeat, discuss 5 microeconomic factors that may influence the financing decision of a firm. Make sure the assignment is done before you attend our next session. Thank you. God bless you. I remain yours truly, Philip Ndeda Sagwa. Bye-bye. What are contingent assets? What are examples of contingent assets? What are the key requirements of IPSAS number 19 in relation to contingent assets? That's what we are going to discuss next. Contingent asset. What is a contingent asset? Contingent assets. Now, a contingent asset is a possible asset. It is, first of all, a possible asset that arises from past event. It is a possible asset. First of all, It is a possible asset that arises from a past event. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future event, not wholly in the control of the entity. Do you understand? If you understood contingent liability, then you can relate to what we are now talking about, contingent asset. It is a possible asset that arises from first of all, a past event. It arises from a past event, all right? Such event arises from a past event, first of all, a contingent liability. It is a possible asset. It is a possible asset. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly in control of the entity. And just like contingent liabilities, contingent assets are not measured. They are not measured but disclosed in the notes to the financial statements. Now, to help us understand better, I'll give examples of contingent assets. Examples of contingent assets. What are examples of contingent assets? One example could be proceeds from a legal or pending lawsuit. Let me say pending lawsuit. Proceeds from a pending lawsuit. Proceeds from a pending lawsuit. Proceeds from a pending lawsuit. One, proceeds. A pending lawsuit, litigation. Proceeds from a pending lawsuit. Now, a company may be involved in a legal or may be involved in a lawsuit against a competitor. That's an example. A company is involved, for example, in a lawsuit against a competitor. If the company wins the lawsuit, against the competitor, it could be awarded a significant financial settlement. And therefore, in such a case, the company has a contingent asset for the potential proceeds from the lawsuit. And therefore, the company should disclose the contingent asset in the notes to the financial statements, because it may not be possible to measure what the court will award in terms of maybe damages or the financial settlement. So we've said that contingent assets are not measured, but they are disclosed. So the company, in such an example, is required to disclose in the notes to the financial statements. The company or the public sector entity is required to disclose proceeds from a pending lawsuit. That's an example. Another example is insurance claims. Number 2, insurance claims. Insurance claims. So a company or a public sector entity may be awarded some money as a result of damage, may be compensated, or indemnified, insurance indemnity, that can also be considered as a contingent asset. 3, tax refunds. Tax refunds is an example of a contingent asset. Tax refund. Government grants. Government grants can go on and on. There are several other types of contingent liabilities. We may also have contingent consideration from a business acquisition, where a company is required to get some money as a result of business acquisition. Contingent consideration from business acquisition. Contingent consideration from business acquisition. Business acquisition. So these are examples of contingent asset. Proceeds from a pending lawsuit, insurance claims, tax refunds, government grants, and also a contingent consideration from a business acquisition. We've defined a contingent liability as a possible asset that arises from past events. It firstly arises from past event that arises from past event, and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the public sector entity. And we've given examples. So we now move on to study recognition of contingent assets. Recognition of contingent assets. Now, a contingent asset is recognized when a certain criteria is met. Just like the contingent liabilities, there is a criteria, or what we may refer to as conditions. And the first criteria is that the entity should have a possible asset that arises from past event. Possible asset that arises from past event. Possible asset. Proceeds from a pending lawsuit is a possible asset. At the moment it's not, but the company may win a lawsuit against a competitor, and after winning, then that money, cash, becomes an asset, but in future. Insurance claims is a possible asset. Tax refunds, possible assets. Government grants, possible assets. Business consideration from business acquisition is possible asset. So the first criteria is that there ought to be a possible asset that arises from past event. Past event. The second criteria is that the existence of the asset will be confirmed. It will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. It's just like the contingent liabilities. Another criteria is the same as the criteria used when recognizing contingent liabilities. The existence of the asset will be confirmed only by the occurrence or non-occurrence occurrence or non-occurrence, the occurrence or non-occurrence of one or more uncertain future events. One or more uncertain future events. For example, proceeds from a pending lawsuit. This may occur, the proceeds from a pending lawsuit may occur in future. May occur in future. The company may receive these proceeds in future. So this contingent liability depends on the fact of the court awarding the company a financial settlement as a result of its lawsuit against a competitor. And you can see the occurrence of such event is not wholly within the control of the public sector entity. It's not wholly. The awarding of this process is not within the control of the entity, but it's within the control of the courts. The third criteria is in relation to the inflow of resource. If it is probable that an inflow of economic benefits will result from the occurrence of the uncertain future event. Inflow of economic benefits. There is likelihood, if it's probable, that there will be an inflow of an economic benefit resulting from the future event, then that's another criteria that can be used by public sector entities in recognizing contingent assets. In recognizing contingent assets. We are now going to study measurement. How are contingent assets measured? And as we have already mentioned, contingent assets, just like contingent liabilities, are not measured, but they are only disclosed in the notes to the financial statements of public sector entities. So I've already answered that question. Contingent assets are not measured. They are not measured. Just like contingent liabilities are not measured, but disclosed in the notes to the financial statements. Are not measured, but they are disclosed to the notes in the financial statements. Lastly, disclosure. What are the disclosure requirements for contingent liabilities? Disclosure. Now, public sector entities are required to disclose certain information about contingent liabilities in the notes to the financial statements. The first information that ought to be disclosed is the nature of the contingent liability. The nature of the contingent, nature of the contingent disclosure requirements. What are the disclosure requirements? Now, candidates, public sector entities are required to disclose certain information about contingent assets in the notes to the financial statements. One is the nature of contingent assets. The nature of contingent assets. That has to be disclosed. There also to be a description of uncertain future event on which the asset depends. A description of a future event on which the asset depends. That also ought to be disclosed. The description of future event on which the asset depends. Then there has to be an estimate of the financial effect. There has to be an estimate. The entity should be able to estimate the financial effect of the contingent asset. The estimate of financial effect of the contingent asset. Estimate of a financial effect of a contingent asset. That has to be disclosed if practicable. Now, candidates, in conclusion, public sector entities should carefully manage their contingent assets. They should carefully manage their contingent assets. And they should disclose such assets in their financial statements in accordance with International Public Sector Accounting Standard number 9. So that effectively brings the lesson to an end. We've covered the key requirements for provisions, contingent liabilities, and contingent assets. I'm going to give you today's revision questions based on International Public Sector Accounting Standard number 19. The first question is in relation to recognition and measurement. Number 1 reads, how does IPSAS 19 guide the recognition and measurement of provisions in public sector accounting, especially regarding the criteria for recognizing provisions in financial statements? Number 2, what are the key principles outlined in IPSAS 19 concerning the recognition and disclosure of contingent liabilities, and how does it differentiate between contingent assets and provisions? Number 3, in what ways does IPSAS 19 address the treatment of contingent assets? That's one question. In relation to that question, another question is, what criteria must be met for contingent assets to be recognized in the financial statements? Number 4, what specific disclosure requirements does IPSAS 19 impose on public sector entities regarding provisions, contingent liabilities, and contingent assets in their financial statements? Number 5, how does IPSAS 19 recommend handling changes in estimates related to provisions and contingent liabilities? What are the disclosure requirements for such changes? Then lastly, what are some of the common challenges or complexities that public sector entities might encounter when applying IPSAS 19 in practice, especially in determining the existence of measurement of provisions and contingent items? These are your revision questions. Make sure you attempt the questions. If you have any question that you may want to pose, feel free to do so. Below this video, there is a comment section where you can post your questions. You can also get us on our lines. You can write to us. You can call us if you have any query regarding the lessons. Thank you for attending the lesson. In our next session, we are going to proceed with the topic Public Sector Accounting Standards. Thank you. God bless you. Bye-bye.
Hi there, my student. Welcome to Manifested Online Classes. My name is Joseph Kemani. I want us to continue with our classes for financial reporting and analysis. And in this session, we are still continuing with our topic number 1, that is accounting for asset and liability. Specifically in this particular topic here, or in this lesson here, I want us to look on IFRS 9, accounting for financial instrument. When talk about what you refer as a financial instrument, generally this refers to those particular securities which are issued by the company for the company to be able to raise capital. And therefore, financial instrument generally include things like shares, things like what you refer as the debentures, things like the bonds issued by the company whenever the company intend to raise what? A capital. But in terms of how financial instruments are defined under IFRS 9. These are defined to be a contract, or a financial instrument we say is a contract which give rise to a financial asset to one of the entity and a financial liability to another entity. For instance, if company A issue some shares or basically issue some debentures, and those shares or debentures are issued to company B, then we say these are contract which is entered into between those two companies, company A and company B, and that contract give rise to financial asset to one of the company and a financial liability or equity as far as the other company is what is concerned. So therefore, we can start by defining what is a financial instrument, and we can say that this is a contract Yes, so therefore a financial instrument here, we are saying that this is a contract which will give rise to financial asset to one of the entity and a financial liability or basically equity to another what? To another entity. Let's take a good example here, or an example. We assume we have a company here, company X, and company X issue some shares. For example, issue ordinary shares or issue debentures in order to raise a capital. And some of these particular shares or debentures issued by company company X, they are issued to company Y. So in this case, once a company issue shares, for example, company X issue shares, and those particular shares or debentures are issued to company Y there, first of all, we say that these two companies have entered into a contract for the issue of shares, or basically for the issue of what? Debentures. Basically what you are saying is that this particular contract involving issue of shares, involving issue of debentures will give rise to financial asset, one of the entity or to one of the company, and a financial liability or equity to the other what? Entity. Because what we know is that once this company, for example, issue ordinary shares, then this company will be able to raise some share capital which is known as the ordinary share capital. Now, this particular ordinary share capital, we know that it is part of equity. It is part of what? Of equity. On the other hand, if this particular company here issued debentures, then debentures issued by the company is a liability because this company is expected to pay some interest. And once those particular debentures matures, then the company is expected to do what? To redeem them in terms of paying back the principal amount. And therefore, these particular debentures issued by the company is a liability, but specifically we refer to them as a financial liability. As a financial what? Liability. So therefore, you can see as a result of that company issuing ordinary shares, that give rise to equity. As a result of that company issuing debentures, that give rise to financial liability. On the other hand, this company here, that is company Y, which will buy the shares, which will buy the debentures issued by company X, then we say that that company has invested. Once a company has invested in shares, once a company has invested in things like debentures, then that is a form of an asset, and specifically it is a form of a financial what? Asset. It is a form of a financial asset. And therefore, you can see that this particular contract here, which has been entered into by company X and also company Y, basically give rise to equity or financial ability as far as company X is concerned, and also give rise now to what, as far as what? Financial asset as far as company Y is what? Is concerned. That's why we are saying a financial instrument here is that particular contract which give rise to financial asset to one entity, financial liability or equity to the other what? To the other entity. At a later stage, we are going to look on the definition. We are going to define what is a financial asset, what is basically a financial liability, and also we do what? We look on the various ways in terms of how financial asset and basically financial liabilities are classified in accordance with this particular standard here, that is IFRS 9. IFRS 9. Before we look on that, I want us to look on something to do with the recognition of financial instrument, recognition of financial instrument, recognition of financial instrument. So when talk about the recognition of financial instrument, basically we say that this is a process through which now an entity or a company should recognize financial instrument or should record financial instrument in its books of account, in its books of what? Of account. Now, a question arises here. Once a company issue shares, or basically once a company issue debentures, or maybe a company has invested in shares or has invested in debentures. So when should the company recognize those particular financial instruments in its books of account? Now, according to IFRS 9, a company should recognize a financial instrument in its books of account when the company becomes a party to that particular contractual relationship. Basically, what that means is that once this company has issued shares or has issued debentures, even if the company has not received cash for those particular debentures or those particular shares which have been issued, then we say that the company has already become a party to this what? A contract. The same case with company Y. Once company Y has invested in shares or basically debentures issued by this company, then we say company Y has become a party to that what? Contract. And therefore, such a company should go ahead and basically recognize or record those particular shares or debentures in its books of what? Of account. So therefore, you can say according yes. So therefore, an entity should be able to recognize financial instrument when the entity becomes a party to the contractual relationship. By becoming a party to the contractual relationship means that once the company enter into that contract of buying shares or debentures, of issuing shares of or debentures, even if the company has not received the cash for the shares or debentures, even if this company which has invested in shares or debentures has not paid for them, then we say that the company has become a party to that what? Contractual relationship. And therefore, such a company, according to IFRS 9, should go ahead and basically recognize those particular shares or debentures issued or acquired in its books of account because the company has become what? A party to that particular contractual relationship. Then from there we need to look on something called the recognition of financial instrument, the recognition of financial instrument. What is the recognition? The recognition basically is the direct opposite of recognition, and the recognition is the removal of a previously recognized financial instrument from the company's books of accounts and financial statement. It is the removal of a previously recognized financial what? Instrument. So therefore you can say yes, it is the removal of a previously recognized financial instrument from the entity's statement of financial position. Now, this particular standard here, that is IFRS 9, has provided the various criteria under which an entity should go ahead and recognize or basically remove a financial instrument from its books of account, and also the financial what? The financial the statement of financial position. I want us to start by looking on the recognition of something called the financial asset. Financial asset. First of all, it is important to remember what you have said here, that financial asset, basically this is an asset which arises whenever an entity, whenever a company has invested in shares or debentures. Equally, as an individual, if you invest in shares, if you invest in various debt instruments like debentures or even bonds or treasury bills which are issued by the government, to you that is a form of an asset. But specifically, we refer to that as a financial asset. So when should a company recognize a financial asset from its books of account? Now we have two criteria for the recognition of financial asset. One is when an entity transfer the risk, risk and also rewards, transfer risk and rewards associated with financial asset. Associated with financial what? Asset. So mean that financial asset should be recognized whenever an entity has transferred the risks and also the rewards which are associated with the financial asset. What do you mean by that? What this means is that if, for example, a company here, that is company X, has invested in shares, has invested in debentures, this company should remove those particular financial asset from its books of account and financial statement whenever that company transfer the risk and rewards associated with that investment. Generally, transferring risk and rewards associated with an investment in shares or debentures, this entails as making a sale. Making what? A sale. Meaning that once this company has invested in shares or debentures, but this company has gone ahead and sold all these particular shares or debentures, then we say that the entity has done what? Transferred the risk and reward associated with those particular financial what? Assets. Therefore, that entity should go ahead and remove those particular financial assets from its books of account and also the statement of financial position. Number two is that an entity should also recognize financial asset when contractual right to receive cash, cash has expired. Contractual right to receive cash expires. Generally, what we know is that once a company has made investment, mostly in a debt instrument, like a company has invested in debentures, so that company, we say, do have some contractual right. That company is having some right to receive interest as far as those particular debentures are concerned on annual basis, and also to receive the principal amount at the end of the life of those particular what? Debentures. Let's assume that this company here, that is company Y, has acquired some debentures, or basically has invested in debentures having a life of 3 years. What does that mean? It means that this company will be having some right, or in other terms, contractual right, to receive interest for the next 3 years, and then to receive the principal amount at the end of the 3rd year. So meaning that at the end of the 3rd year, this company's right to receive cash will expire. Will do what? Will expire. So therefore, what this company should do at the end of the 3rd year, it should go ahead and remove that particular financial asset from its what? Books of account, and also the statement of financial what? Position. So therefore, we have those as the two criteria for the recognizing what we refer to as what? The financial asset. Then from there, we also have something to do with the recognition of what we refer as a financial liability. So let's look on the recognition of financial liability. The condition for, or the criteria for the recognition of financial liability. Financial liability. So first of all, it is important to recall that a financial liability, this is a contractual obligation to pay cash. Generally, a company will be having a contractual obligation to pay cash once a company has issued some debt instrument. For instance, if company Y issued debentures, issue bonds, that company do have or is having some contractual obligation to pay interest and also to pay the principal amount once those particular debentures, once those particular boats do what? Mature. So therefore, financial liabilities should be recognized, should be removed now from the company statement of financial position when an entity's contractual obligation, when an entity's contractual obligation expires or basically comes to an end. Remember what you have said is that assuming we have a company and that company has issued some debentures, those debentures are having a life of 3 years. It means that this company will be expected to pay interest on annual basis, and then at the end of the 3rd year here, the company will be expected to redeem those particular debentures by paying back the principal amount. It therefore means that at the end of the 3rd year, the contractual obligation of this company to pay cash will do what? Will expire, or in other terms, it will come to what? To an end. Therefore, such a company should go ahead and recognize or basically remove those particular debentures, those particular boats from its statement of financial position. So therefore, it is important for you to note here those particular or that particular criteria for recognizing financial instrument, and also the criteria for recognizing both financial asset and also financial what? Liabilities. From there, once we discuss on something else related to financial instruments, and that is something referred to as the compound financial instrument, compound financial instruments, which are abbreviated as CFI. So what do you mean by compound financial instrument? Now, compound financial instrument, CFI, these are those particular financial instruments which contains both equity and liability component. Financial instrument containing both equity and liability component. Good examples of this compound financial instrument are the convertible securities which are issued by companies. When talk about convertible securities, we are talking of things like convertible debentures, convertible bonds, and so on. So those particular convertible securities, we say they contain both equity and liability what? Components. So therefore, we can say that this is a financial instrument containing both equity and liability component. We have said good examples of this are convertible securities. Examples include convertible securities, securities. When talk about the convertible securities here, we are talking of things like convertible debentures. We are talking of things like convertible bonds, etc. We are talking of such securities which are convertible in nature. Why do we refer to them as convertible securities? The reason why we refer to them as convertible securities is because these particular securities, convertible debentures, convertible bonds, they give their holders an option to be able to convert them into ordinary shares of the company. So therefore, we say that they do what? They are compound financial instrument. They contain both equity and liability component. And the reason why we say that they contain those particular two elements, the equity and liability component, is because one, these convertible securities, we say that they confer their holders an option to convert them into ordinary shares. into ordinary shares. Basically, what that means is that once you have invested in convertible securities like convertible debentures, you can be able to convert them into ordinary shares of the company. And basically, what that means is that you have now the right to receive the ordinary shares of the company. That right, which you have to receive the ordinary shares of the company, that right we refer to it as equity, because when talk about equity, this whereby you may have been issued with the ordinary shares of the company, or you have the right to be issued the ordinary shares of what? Of the company. That's why when we are saying that this particular financial instrument contain what? The equity component, simply because the holders do have an option to do what? To convert them into ordinary shares of the company. Number two is that this compound financial instrument requires the issuer to pay interest and principal amount, to pay interest and principal amount. So the company which has issued this particular convertible securities, that company is required to pay interest and principal amount. Now, this obligation to pay interest and also principal amount by the issuer, by the company which has issued these convertible securities, this is a liability. These are a liability, because generally when we talk about liability, a liability we say is a financial obligation. Is a financial obligation to pay some cash. Once a company has issued convertible debentures, convertible bonds, that company has an obligation to pay interest on annual basis and also to pay the principal amount once those particular debentures do what? Mature. In which case, you are saying that obligation by the company to pay interest and principal amount is a form of a liability. So that's why we say that this particular compound financial instrument contain both equity and liability what? Component. Now, in terms of how this compound financial instrument, the CFI, are accounted for, they should be accounted for in accordance with the International Accounting Standard number 32, which requires that on initial recognition, then the two component, the equity component and the liability component, must be separated. So therefore, here we can say that IAS 32, International Accounting Standard number 32. Yes, so International Accounting Standard number 32 requires an entity to split. The equity and liability component. The two components must be separated, of which I have said that recognition, separation must take place on initial recognition. Once a company has issued convertible securities like convertible debentures, convertible bonds, when the company is recording them in its books of account, the company should split the two components, equity component and the liability component. Now, this standard here, International Accounting Standard number 32, has gone further and steps to be followed whenever an entity is splitting the two components. And step number one entails computing the liability component. So what that means that once a company wants to determine the liability and equity component, the first thing is that the entity should be able to do what? To determine the liability component. So therefore, you can say number one, or step number one, is compute entail computing the liability component. Entails computing the liability component. Now, this liability component arises from the entity's obligation to pay interest and also the principal amount during the life of convertible securities. And therefore, in terms of how we determine the liability component, we determine this by adding two items, or two items. So number one, we add the present value of the annual interest plus the present value over the principal amount. The principal amount. For you to be able to understand this, let's assume here we have a company, and that company has issued some debentures, and those debentures are having a life of 3 years. We assume a company issued debentures, like 10% debentures, or we just refer to them as 10% convertible debentures, having a value of 5 million, having a value of 5 million, and equally these particular debentures issued by the company, convertible debentures issued by the company, they have a life of 3 years. What therefore this means is that this company over the next 3 years will be expected to pay interest, of which this interest, in most of the cases, it is payable annually and also at the end of the year. At the end of the 3rd year here, our company will be expected to do what? To redeem these particular debentures. If the holders will not exercise the conversion rights, will not convert them into ordinary shares, what will be expected is that the company will redeem them in terms of paying back the principal amount. So therefore, for you to be able to determine or to compute this liability component, what you just need to do is to discount, to get the present value of this annual interest, of which that annual interest is basically an annuity for the purpose of discounting, and then you also discount this, get the present value of this. So, and then add the two. Whatever you get is what you refer as the liability component. And then that particular liability component will then need to be amortized. Will then need to be amortized, will then need to be written off over the next 3 years, because it represents an obligation on what the company should pay over the next 3 years. So once we have computed that liability component, step number 2, we then proceed, or an entity should then proceed and compute the equity component. Compute the equity component. So how is the equity component computed? The equity component is computed by taking what we refer as the sales proceeds. So when talk about the sales proceeds, we are talking of the amount of money which was received by the company, amount received by the company from issuing this compound financial instrument. How much amount was received? Always you'll have been, anytime you come across such a question, you'll be told how those particular convertible securities was issued and how much amount did the company receive. So, and then to this, what you do, you less the liability component, component, which was computed in step number 1. Computed in step number 1. And once you deduct it from the sales proceeds, or basically the amount of money which was received, whatever you get here as the difference, we refer to that as equity component, of which this equity component, the value for this equity component remain constant throughout the life of those convertible securities. So therefore, according to this particular standard here, that is International Accounting Standard number 32, anytime an entity issues a compound financial instrument, a CFI, then the two components, the liability component and the equity component, must be splitted, must be separated. And in doing that, we have said step number 1 is that the entity should be able to compute the liability component. Basically, that is computed by adding two values, the present value of the annual interest plus the present value of the principal amount. And step number 2, the entity should proceed and compute now the equity component by taking the total amount which was received from issuing such a compound financial instrument minus the liability component, which we computed there in step number 1. And basically the residue amount here, which is now the difference, that now represent what? The equity component. So therefore, that basically what you need to know as far as the compound financial instrument, the CFI, is concerned. you'll be able to come across some computation questions as far as this is concerned. Once you proceed to the advanced level in the unit called Advanced Financial Reporting and Analysis, you'll basically come across now some computation questions. At this level, that is in the intermediate level, in the unit called Financial Reporting and Analysis, you just need to know what is a CFI, what is a compound financial instrument, and how should the two component, equity component and also the liability component be what? Be separated. So that basically what you need to know as far as that is concerned.
Hello learner, welcome to Manifested E-Learning Platform. My name is F.A. Mningwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss about portfolio management. The focus is on contemporary issues and emerging trends. We are going to discuss about program trading, and we say the following, I can write the following, that it refers to volume trading, which is done by systems, executed by systems, usually automated, based on an underlying, let me write it properly, apologies for that, based on an underlying program or idea. Let's stop there for 1 second, guys. It refers to volume trading, which is done or executed of portfolio strategies. Involving the purchase or sale. Purchase or sale of stocks. We can say purchase or sale of 15 or more stocks, 15 or more stocks having a total market value, total market value of $1 million, $1 million, or even more, Stop there. It is a wide range of portfolio strategies involving the purchase or sale of 15, ladies and gentlemen, or more stocks having a total market value of $1 million or even more. Now, once we have introduced what program trading is, it can almost be referred to as algorithmic trading, high volume trading that involves the utilization of a given number of strategies, ladies and gentlemen. And we're also saying that the strategies could be, or the types could be either principal, they could be either basis or even contra-day strategies thereon. So we can continue and say that program traders are almost always program can come on this other side. Traders are almost always program traders are almost always executed by computers. Executed by computers. Although there are instances we can say although there are instances in program trading, there are instances when this isn't the case. When this is not the case, for example, institution X, institution X wants to sell a basket of 15 stocks. Wants to sell a basket of 15 stocks totaling $2 million. Totaling to $2 million. $2 million. $2 million. It would simply split up. It would simply split up the sale among different brokers. Among different brokers. In other words, you're saying that people plan the strategy and you're saying the computers are the ones that do the work. So traders are almost, I've written R twice, are almost always trades are almost always executed by computers. But although there are instances when this is not the case, for example, institution X wants to sell a basket of 15 stocks totaling $2 million. It would simply split up the sale among different brokers. So when people plan strategies and the computer does the work, this is how program trading looks like. So we have this computer right over here. Please forgive my drawing right over here. And I'm saying that here is where the coding or the codes are actually created. Of course, there has to be what you're calling the CPU right over there like that, and it's the one that actually does or processes or executes trades. Buy and sell. You can put it in a different color over here. Buy and sell. Buy and sell of securities. Of securities. Buy and sell of securities. Then we are saying the types can be of 3 of them. Types of program trading can be where the principal over here we are saying this is where replication of an index is actually ensued. So replication of an index where the portfolio manager or the strategies try to copy the returns that have been generated by an index. And that is all done by the program trading or by the computer. So replication of an index. Then the second type of program trading is basis over here, and over here trying to identify price inefficiencies, strategy to identify price inefficiencies. So the computer tries to identify price inefficiencies, trying to identify undervalued stocks, or tries to identify undervalued stocks. Undervalued stocks is what the computer system actually buys those stocks, of course using an algorithm, and the overvalued stocks are actually sold. Then finally, the third type of program trading is contra trading, buying and selling through buying and selling consistently like that. So we're saying we buy in one market and sell in another market right there. So we're saying that's what happens in a contra. Buying and simultaneously selling the same security. Buying and selling the security simultaneously. So of course this uses futures or options, and that is actually executed using the computer system. So we're saying what? We're saying that the types of program trading include the principal, which involves replication of an index, and that is done by the system, by the computer system or algorithm. Basis trading, which involves a strategy to try and identify pricing inefficiencies, undervalued stocks and overvalued stocks. Then there is contra trading, where you buy and sell securities simultaneously in different markets using futures contracts. Let's move on this other side. Let's look at the advantages. Advantages of program trading. We're saying it is quick to execute and implement. It is quick to execute and implement. Number two, over here we say places trades according to strategy. It places trades according to strategy. Number three, exploits opportunities without emotions. It exploits opportunities without emotions. So it is quick to execute and implement. Execute and implement are the keywords there. Second, it places trades according to strategy, either basis, principal, or contra, actually executed using algorithms. So you can be able to come up with an algorithm that actually executes principal strategies, basis strategies, and even contra strategies. Very simple. It exploits opportunities without emotions. That is very key. So having looked at the advantages, we move over and discuss the disadvantages. Disadvantages. We are saying that number one, it brings about extreme volatility. For example, in the 1990s, it brings about extreme volatility. And for example, in 1990s, there was a bit of a flurry of activity that took place as a result of program trading. Number two, it is expensive. It is costly to implement and trade. It is costly to implement. So these are the two main disadvantages over here, that it brings about extreme volatility, for example, in the 1990s, and it is costly to implement. So this brings us to the end of the lesson. We hope you have enjoyed it, and I will leave you the assignment. The assignment is as follows, right down here. Assignment. Explain what is meant by program trading. Explain what is meant by program trading. So thank you for being with Manifested Publishers. Continue being with us, and we are here for you.
Welcome to Manifested Publishers.
Hello, Lana. Once more, welcome to our today's session. We're still discussing the broader subject, derivatives analysis, and we are looking into the various types of derivatives that we could be having. So we have been saying that the types of derivatives are of three major categories. Number one being forward commitments. Number two being contingent claims. And the third category being exotics. So we have said that forward commitment gives us three major types of derivatives, which are forwards. And forwards, we have said, these are customized instruments, and they trade at the OTC market, over-the-counter market. Then we have futures. These are standardized, and they do trade at the listed exchanges. Then we have another category, swaps, and predominantly they also trade at the over-the-counter, meaning that they are customized. So all those forward commitments are agreement where one party decides or agrees with another party to do something for the other. So with contingent claims, we primarily saw that these are options, that with options, these are rights, with the right to buy being called call, and the right to sell being called put, an underlying asset at a particular price agreed at the start of the contract. Also, there is also the payment of an option premium at the start. Now, exotic, this we said these are combinations of various derivatives, combinations. They are combinations or variations to the derivative instrument, and they come about due to financial engineering. Right? So, and because of the combination and variation, all of them, all the options are highly customized. They are highly customized. Now, our topic still, we are discussing the exotics, and we saw that the exotic option of various categories, and we saw a list. And in our previous session, we were able to see, for example, the compound options, which were just being options on options. These were options on options. And there are various categories of compound options. Basically, so 4 in number. You have a call on call. We could have a call on put. We could have a put on call, or also we could have a put on put. So as the various variations to the normal core options. Then we did see something to do with a break forward, and we said this will be able to give an option on the holder to be able to manage the exchange rate risk. Exchange rate risk, and predominantly they are also referred to as the Boston option. Then another category we were able to see was the binary option. Now, with binary options, these were referred predominantly in the market as what you call the digital options. The digital options, and why they are so is because they have the discontinuous payoff. They have the discontinuous options, payoff, sorry. They have their discontinuous payoffs. Now, today's class, we are going to see a third category or another category of the exotics, which we call the barrier options. Now, the barrier options, these are options primarily where the payoffs depends on whether the underlying assets price reaches a certain level during a specified period of time, So, because they are variation, and then we say most variations or derivative instruments are customized, they will be able to trade at the over-the-counter. Over-the-counter, we said, is abbreviated as the OTC because they are customized instruments. Okay, and then why are then options that their payoffs depend on whether the underlying asset price reaches a particular level during a specified period of time attractive to practitioners within the derivatives market? They are very attractive because they are less expensive. So that is what makes it the barrier options very attractive to investment practitioners within the derivatives market. Now, these barrier options still can be classified as either two broad categories, depending whether they come to life or they cease to exist. One is what we call the knockout option. The knockout option. Now, and the other category is called a knock-in option. Yeah, binary option. So in a knockout option, we are saying now this option will cease to exist when the underlying asset price reaches a certain barrier. So a knockout option will cease to exist. Cease is they terminate, or they expire, they cease to exist when the underlying asset price reaches a certain barrier. Now, with a knock-in, as the word suggests, now they are bringing their life back. So with a knock-in, they come into existence only when the underlying price or the asset price, the underlying price of that asset reaches a particular barrier, So a knock-in option will just come into existence only when the underlying price, the asset of that underlying price reaches a particular barrier. Now, we basically said that an option grants the holder of that option, grants the investor of that option two rights, either the right to buy, which you're calling the call, or the right to sell, which you're calling the put. Now, similarly here, barrier option can be classified further depending on whether it is based on the call or depending on whether it is based on the put. When that consideration is made, then we have a further classification of barrier option called the core barrier options, and we have the put barrier options. Now, the rights are two: the right to buy call and the right to sell put. Then the major classification of either a knock-in and a knockout will still apply to a call option and a put barrier option, a call barrier option and a put barrier option. When that is done, then we have two categories, and it is based on the underlying price of the asset, the underlying asset price. So we must set two things. We must set whether the underlying asset price goes below, when it goes below the set barrier, or the set level, or the underlying asset price goes above the set barrier. So we have those two scenarios, for each. We can have below or we could have above, right? That market prices of asset, the underlying asset, could change over time. They can either go above a set barrier or they can either go below. Now, when they go below the initial level of the asset price, then we can have two variations. So they are going below what? The initial level of the asset price, So they are going below the initial level of the asset price. Now, here we are able to generate two options, a down and out, a down and out call option. So in a down and out call option, what happens is that now, first, we have said the asset prices could change. When they change below the initial level of the asset price, then we can be able to get a down and out. So down shows the asset, the level has fallen, right? And out now, it means it ceases to exist. So with this one is that this is an option now, will cease to exist. Will cease to exist when the asset price falls below the initial level there, falls below the initial level, level. So having seen that we could be having the asset price maybe below, so we could also have associated with that a down and in call option. Now, a down and in call option will be able to generate now value because there are two things. The asset price has fallen, right? Now, in, and we say in now, we are able to come into existence. So this in a down and in comes into existence, when the asset price falls below the set barrier. Yeah, falls below the set barrier. Consequently, we also said that the asset prices, the prices of those assets could also move above. So they could move above. So this also presents us with opportunities to be able to see now above. Now we've just have what we call up to represent the above and out, right? Call option. So with an up, it means that the level of the asset price is moving above the set barrier, and out now they cease to exist. Therefore, this variation of the call option is a standard call option but varies. Now, by variation, we mean it now ceases to exist when the asset price rises above a set barrier. So that is that. So also consequently, we could be having an above movement, but now a call option that comes into life. So that one gives us another type of the core barrier option. Now we have an up, yes, up meaning that the level of the asset price has risen above a set barrier. Then we have up and in. So bringing in the aspect of knocking. So up and in call option. So what really this also means is that now the right now comes into existence when the asset price rises above a set barrier. Right. So similarly, what we have done for the call barrier option should be done to the put barrier option to be able to understand the types. So for the put barrier options, we'll be having the asset prices selling below. So in below, then we could have similarly a down and out put option. And in a down and out put option is now, because it is out, is ceasing to exist, ceases to exist when the asset price, falls below the set barrier. So also we could be having a down and in put option. So in a down and in now it's coming into existence. So comes into existence when the asset price reaches a set barrier. Similarly, the asset price, market rates could be changing, market prices could be changing, and they could trade above a set barrier. We could be having also two kinds of put options here. One is up and out put option. So this is a variation on the put option contract, where now this contract ceases to exist when the asset price rises above the set barrier, And also, lastly, we could be having an up and in put option. So this one comes into existence when a set barrier is reached. This now takes us to the end of our lesson, and to assist us to be able to understand this concept better, it is good that we have an assignment. So, for our assignment, explain the meaning of the following types of exotics. Number one, binary options. Number two, barrier options. Number three, core barrier options. And number four, put barrier options. For our assignment, we are required to explain the meaning of the following types of exotics. Number one, the binary options. Number two, the barrier options. Number three, the core barrier options. And lastly, but not the least, the put barrier options. Thank you. Good
Good day, my student. Welcome to Manifested Online Classes. My name is Joseph Kemani. In this session, I want us we look on some illustration questions on the topic of income taxes. I want us we look on a number of illustrations so that you can be able to understand how we compute the current tax and the deferred tax. So here we have a number of questions from the past papers. We have the question for April 2023, question 5A. We also have another question for May 2018, question number 1B. So these are theory questions coming from that topic of income tax. So I want to give those particular two questions as an assignment. And equally, if or once you attempt those particular questions, maybe you have a challenge, I usually encourage my student to acquire this revision kit prepared by Manifested Publishers so that you can be able to counter check the solution for the same. So therefore, make sure you attempt those two questions there, which are theory question. Then from there, I want us now we do this particular question here for April 2023, which is question number 5B, and which is a computation question. So let's go through that question there, and it reads, BXL Manufacturers Limited, a small firm engaged in the production of fertilizer, purchased an item of equipment for shillings 12 million on 1st July 2018. The company provides depreciation on equipment on a straight line basis at the rate of 25% per annum during the 4 years from 1st July 2018 to 30th of June 2022. The profit after tax. So that particular profit there was a small error with that question. That was supposed to be profit before tax, because you can see in the requirement down there, we are required to compute the tax. We are required to compute now the taxable what? Profit. So therefore, what we are given there, that was supposed to be profit before what? Tax. And then we have now the allowable wear and tear charges. This what in other terms we refer to as the capital allowances. So we are given the profit before tax actually for the 4 years, and also we are given now the rates of computing the allowable wear and tear charges. Then from there we are told the corporate tax for the period of 4 years remained at the rate of 30%. And then what you are required from this particular information one is for each of the year which ended 30th of June 2019, 2020, 2021, and 2022. Number one, we compute the taxable profit, and number two, we compute the deferred tax. We compute the deferred tax. So we can start with the Roman 1, whereby we are required to compute now the taxable profit. But I think before we do that, there are some items, two items we need to compute, because we are going to use them in terms of computing the taxable profit. Number one, we can compute the depreciation, because we are given information about depreciation there. So let's compute the annual depreciation per annum. And what you are told is that the depreciation here on the equipment which was acquired as per the information we have in paragraph 1, that equipment had a cost of 12 million. And you're told that this company is depreciating that particular equipment at the rate of 25% using straight line method. We have to recall here, at the straight line method, depreciation is computed based on the cost. So therefore, to compute this particular depreciation, we take now the rate which you are given times the cost of this equipment. The cost of the equipment in our case is 12 million. So we get 25% of that, which is basically the same with a quarter, and that will give us 3 million. So meaning that the depreciation per annum of this particular equipment, or basically the depreciation of each year for the next 4 years, will be shillings 3 million per annum. So that is the depreciation. Then from there we need to compute the wear and tear allowances. Remember, in this case, we have said that this is also known as the capital allowance. The capital allowance, or in other terms, we refer to this as the capital deduction. So for the period of 4 years, we are given the rate of computing that particular wear and tear allowances. in year 1, which is now the year 2019, we are told it is 40%, and basically this should be 40% of the cost of this particular equipment which was acquired. So we know that the cost of the equipment which was acquired was 12 million. In the year 2020, it is 30% of 12 million. And then in the other year, which is the year 2021, the rate there is 20%, and it should be 20% of the cost of the equipment, which is 12 million. And the year 2022, the rate is 10% times 12 million, times 12 million. So we need to compute this particular capital allowances, because we need this information in computing what is required in Roman 1 and also Roman 2 of that question. So the capital allowance for the first year is 40% of 12 million, and that will give us 4.8 million, 4,800,000. So in the other year, which is year 2, it is 30%, which will give us shillings 3.6 million. And then the other year there is that is the year 2021. It is 20% of 12 million, and that will give us what? That will give us okay, we can retake that again. 20% of 12 million. Yes, that will give us 2.4 million, and 10% of that will be 1.2 million. 1.2 million. So these are the capital allowances as far as this particular equipment is concerned. Now, the first thing we need to recall here is that this particular capital allowances, or this wear and tear allowances, these are allowable expenses. But on the other hand, we know that depreciation, this one, is a desirable expense. So therefore, if you check on what we are required to compute in Roman 1, we are required to compute now the taxable profit. We are required to compute the taxable profit. So how do we compute this particular profit here, the taxable profit? To compute the taxable profit, we take the accounting profit which is given there. The accounting profit, in other terms, is the profit before tax. Remember, I've said that question had a slight problem, a slight typing error. So that was supposed to be profit before tax and not profit after tax. So we take that profit before tax, and then to this we add back the disallowable expenses, disallowable expenses. So when talk about the disallowable expenses, these are those particular expenses which are deducted in arriving at this particular profit, but they are not supposed to be deducted in accordance with the tax rules. So what we do is that we add them back, and then we less allowable expenses which have not been deducted in arriving at this particular profit. Now, in this particular question here, we only have one allowable expense, and that is now the wear and tear allowance, or the capital allowance. Now, for taxation purpose, capital allowances, this is allowable expense. Whenever a company is computing the taxable profit, the company should deduct this particular capital allowances. But always, in arriving at the accounting profit, those particular capital allowances will not have been deducted. On the other hand, here we only have one disallowable expense, and that is the depreciation. And the reason why we are adding back that particular depreciation is because in arriving at the profit before tax which you are given there, depreciation has already been deducted, but according to the existing tax rules, depreciation is disallowable expense. So therefore, what we need to do, we need to have various columns here for the years which are given. I hope you can see we are given information about 4 years, 2019 up to 2021. So we have years here, 2019, 2020, 2021, and then 2022. The figures we are given there are in thousands of shillings. So we need to indicate that all our figures will be in thousands of shillings. Will be in thousands of what? Of shillings. That what we need to have first of all here. And then we need to start with the profit. Remember, I've said to compute this taxable profit, we need to start with the accounting profit. Accounting profit, I've said, is the same with the profit before tax. That is what you're given, and that's what you're going to start with here. The profit before tax. And then in this case, we are saying to this particular profit, we are going to add back what? Desirable expense. And basically, I've said the desirable expense which we have in this particular question is what? Is depreciation. But before you do that, let's have the profit before tax, which you are given. Say in the first year, it was 2,400. Then the other year was 27. The other year was 2,850. And finally, we have 2,550. That is the profit before tax, which is the same with the accounting what? Profit. And then now to this, what do we need to do? We need to add back the desirable expense, which has already been deducted in arriving at this profit, and that is the depreciation. Remember, you have computed the depreciation per annum here, which is an amount of 3 million, and basically this is per annum. The depreciation for 2019, 3 million. For this year, 3 million. 2021, 3 million, and that year, 3 million. So we add back that, and then to this now we less the allowable expenses, which are allowable expenses which have not been deducted in arriving at this profit. It is this capital allowance, or these wear and tear allowances. So we less wear and tear allowances. So for the first year is 4,800. So, but remember our figures are in thousands of shillings. We are going to take that as 4,800. And then for the other year is 36. The other year here is what? Is 2,400. And then finally here we have what? 1,200. We have 1,200. So after doing that, now what you're going to determine, or basically to get down here, is the taxable profit. Is the taxable profit. So let's compute this taxable profit, starting with the first year. In the first year, we have 2,400 plus 3,000 minus 4,800, which will give us a taxable profit here. Taxable profit of 600. And then we have 27 in the year 2020. Plus 3,000 minus 3,600, 3,600, which will give us 21. Which will give us 21. Okay, let me counter check this whether that is correct. I've said we have 24 plus 3,000 plus 3,000 minus 48. Yes, that is okay. It is 600. So let's go to the year 2021. We have 2,850 plus 3,000 minus 2,400. So this will give us 3450, 3450, and finally we have 2550, 2550 plus 3,000 minus 1,200. So that will give us what? Will give us 4350. 43 what? 50. So this is now what the examiner was requiring. You are required to compute that that what? Taxable profit. Taxable profit. So let's move to Roman 2 of that question. Roman 2 of that particular question, we are required to compute what? We are required to compute the deferred tax. We are required to compute the deferred tax. The deferred tax. So what is the deferred tax? Remember, in this case, we have said that deferred tax is basically the tax which will be payable or recovered by the company in the future. And mostly we said, or actually we say deferred tax arises due to the difference between accounting profit and taxable profit. Accounting profit and taxable what? Profit. So what we need to do here for us to compute the deferred tax, we need first of all to compute something called the timing difference. The timing difference. So what is the timing difference? The timing difference, this is the difference between accounting profit and taxable profit, which give rise to deferred tax. I hope you can see in our case, we already have the accounting profit. Remember, accounting profit is the same with the profit before tax. So whatever you have here, this is what? This is the accounting profit or the profit before tax. And at the same time, you can see we have what? The taxable profit. Now, if you compare these two profit here, accounting profit, taxable profit for the period of 4 years, you can see that profit is not the same. So once those two profits are not the same, then we are saying that automatically will give rise now to deferred what? Tax. So therefore, we compute the timing difference as the difference between accounting profit and taxable profit. And then to determine now the amount of deferred tax, we multiply that with the tax rate. We multiply that with the tax rate. So let's have that summary here. We are going to compute the deferred tax for the 4 years. We start with 2019, 2020, 2021, 2022. So what we need to do here is to have the two profits. We can start with the accounting profit. Accounting profit, you have to remember, is the same with what? Is the same with the profit before a tax. And then we have the taxable profit. The taxable profit, the difference between these two profit is what you are referring to as the timing difference. Timing difference. We are going to have now the other column there for the timing what? Difference. And also our figures here are in thousands of shillings. Figures are in thousands of shillings. So these are quite simple now. We just need to transfer what you have here. So let's first of all have the accounting profit. The accounting profit for the first year is 24. What we have here, 27. Then here we have 28 what? 28.50. And then we have what? We have 25.50. 25 what? 50, 25.50. Then we have the taxable profit. The taxable profit is what you have computed here. 600, 2100, 24.50, and then 43.50. So what we just need to do here is to get now the difference between those two what? Figures, the accounting profit, taxable profit, and the difference now will be what? Will be the timing difference. Will be the timing difference. And then once we compute that timing difference, we have said to compute the amount of deferred tax as required in the question, we just take the timing difference times what? The tax rate. So meaning that here we also need to have another column here for deferred tax. For deferred what? Deferred tax. And basically this deferred tax will either be a deferred tax expense or a deferred tax income. So any figure which is basically a negative figure here will be a deferred tax what? A deferred tax income. So let's get the difference here first of all. This minus this will be 1800, which is a positive figure. This minus this will give us 600. And then this minus this. Okay, this should be what? Let me check. 27 minus 21. That will give us 600. 600. And then we have this minus that. 2850 minus 2450, which is 400. And then this minus that, which is 2550 minus 4350, which will give us what? Which will give us 18 what? 1800, but this 1800 you can see is a negative. Is a is a negative, yes. And also this figure, there is a figure we have recorded longer here. This is 3400, not 24. Yes, so let's compute that afresh. We have 2850 minus 3450. Yes, this will be negative 600, not positive 400. This will be negative 600. So having that, then what do we need to do finally? We need to compute the amount of deferred tax. So the deferred tax, we take the timing difference, which we have here, times the tax rate. I hope you can remember that question we are told. The tax rate for this company for the period of 4 years in the last paragraph, we are told is 30%. 30%. Tax rate in our case is 30%. So we take this timing difference times the tax rate. So in the first year, we have 1800 times 30%. That will give us a 540. And a positive figure here is a deferred tax expense. A negative figure is a deferred tax income. So we do the same here. We take our timing difference times the tax rate. That will give us 180, which is still a deferred tax expense. So these are deferred tax expense. And then here we have 600 times 30%, which is negative 180. A negative figure we have said is a deferred tax income. What about here? This will also be 540, which is still a negative. So this is deferred tax what? Income. Deferred tax income. So therefore, that's what was required as far as that question is concerned. The computation of the deferred what? Tax, which I've said can either be a deferred tax income or a deferred tax what? Expense. So therefore, that is it as far as that particular small question is concerned. But equally what you have agreed, make sure you attempt the other questions. April 2023, question 5A, and then May 2018, question 1B, which are theory questions. But equally, I've said that if you have a challenge, make sure you acquire this revision kit and you try to, or basically you check on the solutions for the same at the back of that particular book. So that brings us to the end of that subtopic on income taxes. Let's meet in our next class as we look on the other subtopic still in topic number 1.
Hello candidates, welcome once again to our today's financial accounting lesson. The topic is Introduction to Public Sector Accounting. In our last lesson, we started on the subtopic regulatory structures and oversight, and the first structure we covered is the International Public Sector Accounting Standards Board. In our today's lesson, we are going to tackle the Public Sector Accounting Standards Board, which is the Kenyan version. All right, the Kenyan version. The previous one was the International Public Sector Accounting Standards Board. Today we want to consider the board that was put in place by the Act of 2012, the Public Financial Management Act. So candidates, let us look at the Kenyan version of Public Sector Accounting Standards. The topic is Introduction to Public Sector Accounting. The subtopic is Regulatory Structures and Oversight. So we are yet to get the oversight. We are still on the structures, regulatory structures. The topic is Introduction to Public Sector Accounting. I've just mentioned that today we will consider the Public Sector Accounting Standards Board. Okay, Public Accounting Standards Board. This is the abbreviation of the Public Sector Accounting Standards Board. It is a board, all right, a board. So by the end of this lesson, candidates should be able to explain or highlight the establishment, be able to explain the establishment of this board, the mandate, and the functions. And the functions of PSA-SB, the Public Sector Accounting Standards Board. Now, this board, the PSA-SB board was established and instituted in accordance to sections 192, section 192 and 193 of the public financial management Public Financial Management Act. Okay, Act is an act of Parliament of the year 2012. Parliament enacted this act in 2012, and is on the basis of this act, right, that the PSA-SB was formed. Remember, we are discussing the establishment, the mandate, and functions of regulatory structures in the public sector. One regulatory structure is the Public Sector Accounting Standards Board. So this act, do I need to mention the Gazette notice? Do I need to mention the Gazette notice, or let me just mention it? The act through, let me say, through a Gazette notice number. Okay, let me just have the number 1199, number 1199. All right, and it was on the date of 28th of August 2014. 28th of August 2014. The act was put in place in 2012, but the board was established in 2014 through a gazette notice that was issued, the gazette notice number 1199, 1199 that was issued on 28th of August 2014. Okay, so I'll not be surprised if you do not know anything about it, because in 2014 these were the emerging issues in accounting. It is no longer emerging because this board has been established and instituted. That's why in your syllabus there is the last topic there, emerging issues. It's no longer emerging, it has already emerged, and we have the act in place. From 2014 we have the board, public sector accounting standards board. So that is the establishment. It is established on the basis of the Public Financial Management Act. So candidates at the cabinet level, this board is represented by the cabinet secretary to the National Treasury. At the cabinet level, the board is represented by none other than the cabinet secretary to the National Treasury. The cabinet secretary to the National Treasury is the representative of the board at the cabinet level. So that is the establishment. Now let's discuss briefly the mandate. Now the mandate of the PASB, and the functions are established in part 4 of sections. This is part 4, let me say, part 4 of the Public Financial Management Act. Sections 192 to section 195. So let's have the mandate. What's the mandate? The mandate of this board, number one is set generally accepted accounting and financial standards for public sector entities. That is the first mandate, to set generally accepted and financial standards for public sector entities. The second mandate is to prescribe and pronounce generally accepted internal audit standards. That is the second mandate of this board. Then the third mandate is mainstreaming, let me say, mainstreaming of best practices, for good governance, internal controls and risk management, okay, and risk management in the public sector. Risk management in the public sector. To set generally accepted accounting and financial standards for public sector entities. Number 2, prescribe and pronounce generally accepted internal audit standards and mainstreaming or benchmarking in the best practices for good governance, internal controls and risk management in the public sector. So candidates, this means that in setting these standards, the board, this Kenyan board, has to take into consideration international best practices in public sector accounting standards. Has to take into consideration, okay? It has to benchmark on the international best practices for good governance, internal controls and risk management in the public sector. So this is the mandate of Public Sector Accounting Standards Board. Now let's discuss the functions of this board. Functions of Public Sector Accounting Standards Board. This board that was formed by the Public Financial Management Act of 2012. Function number one, the first function is set generally accepted accounting and financial standards. The second function is to prescribe minimum standards of maintenance of proper books of accounts for all the entities in the public sector. Proper books of accounts for all public sector entities. Books of accounts for all public sector entities. The third function, number 3, is to prescribe internal audit procedures which comply with the Public Financial Management Act. Right, which comply with the Public Financial Management Act. Then the third function of this board, the fourth function of this board is to prescribe formats for financial statements, and reporting, financial statements and reporting, by all state organs, all the organs of the state and public entities. That is function number 4. Function number 5, candidate, is to publish and publicize the accounting and financial standards and any prescribed guidelines, and directions prescribed by the board. Publish and publicize. Number 6, the sixth function is to do what? It is to gazette the dates of application of the standards. Okay, but that has to be done in consultation with the cabinet secretary. So I can write, can say, in consultation with the cabinet secretary, cabinet secretary on the effective dates for implementation of standards, comma, gazette the dates for application of standards and guidelines, guidelines. This has to be done in consultation with the cabinet secretary. Cabinet secretary. Then there is another function, candidates. Function number 7, to monitor. Here is implementation. She is following a certain order. Gazette. This is prescribing, coming up with the standards. All right. Then we're talking about implementation of the standards and guidelines. Here we are talking of monitoring. To monitor, number 7. To monitor. Monitor the adherence. To monitor the adherence to the standards by all the state organs and public sector entities Then we will put down the last function. This is function number 8, the last function of the PSASB. Number 8 is to promote transparency and other constitutional values and other constitutional values and principles values in effective, prudent, and prudent, okay, effective, principles in efficient and prudent management, of revenues, expenditures, liabilities and assets of the state organs and all the public sector entities. That is the 8 functions of the public sector accounting standards. So candidates, that will mark the end of our today's lesson. Remember, the objective of the lesson was that by the end of this lesson, you, the learner, should be able to explain the establishment, the mandate, and the functions of the Public Sector Accounting Standards Board. That was the objective of today's lesson, and it is my hope that I have done my part. The ball is now in your court to ensure that we internalize what we've been learning today so that you are able to understand the public sector accounting. This is just but an introduction to public sector accounting. What we learned here is very important. We've done the second structure, regulatory structure. Okay? We've looked at a body, regulatory body, which is the board that has been formed by an act of parliament. That is the Public Financial Management Act. We've looked at the mandate and the functions of this board. So I'll stop there for today. We continue to learn more about public sector accounting in our subsequent lessons. For now, I say bye-bye.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners.
Greetings to you all and welcome to the lesson. The subject is financial management. During the last lesson, I introduced the new chapter on financing decision, and we began by studying the nature and objectives of financing decision. During that lesson, we said that the nature of financial decisions varies from one firm to the other. We said that it may also be different for the same firm over a period of time. And the reason being that the nature of financial decisions is influenced by the prevailing microeconomic and macroeconomic conditions. We went further to study 5 microeconomic conditions. 5 microeconomic conditions. Microeconomic conditions. We discussed 5 microeconomic conditions, beginning with the nature and size of a firm, nature and size of a firm. We discussed how the nature of a firm influences the financing decision. We also discussed how the size of a firm can influence the financing decision. During that lesson, we also discussed how the level of risk and earnings. We discussed how the level of risk and earnings may influence the financing decision of a firm. The other factor is liquidity position. By now, candidates, you know how liquidity position of a firm can influence the financing decision of a firm. Number 4, asset structure. The asset structure and what we called the ownership, the pattern of ownership and pattern of ownership. Then lastly, we studied how the attitude of management can affect the financing decision of a firm. These are 5 microeconomic factors or conditions. That's what we covered in our last lesson. In today's lesson, I want us to now focus our attention on the macroeconomic conditions. Macroeconomic conditions. Macroeconomic factors or conditions. These are conditions that may influence financing decision of a firm. The macroeconomic conditions, candidates, are the factors that are beyond the control of the management. These are environmental factors that are beyond the control of the firm's management. Unlike the microeconomic conditions, which we said, these are factors that are internal to the organization. These are factors that can be influenced or they can be controlled by the management. On the other hand, macroeconomic conditions, these are conditions or factors beyond the control of the firm's management. They are beyond control. They are external factors. All right? An example is, say, the state of the economy. One factor is the state of the economy. The state of the economy. The state of the economy. How can the state of the economy influence the financing decision of a firm? Remember, we are discussing the macroeconomic factors that have an impact on the financing decision of the firm. Now, candidates, we know that the state of the economy changes from time to time. And therefore, the financing or the financial decisions of a firm should also conform to such changes. The economy changes from time to time. And if the economy changes from time to time, that means that the financing decisions that are made by a company will have to change in order to conform to the changes in the external environment. For example, when the economy is growing or it is proceeding towards recovery, the finance manager should be eager to avail investment opportunities. But when the economy is facing a slump, then the finance manager should proceed with care. When the economy is on a downtrend, then that means the finance manager should shy away from investing in new projects. So this economy could be recovering or growing. Economy can also be slowing down, what we are calling a slump. So those two economic conditions, the state of the economy, can affect the financing decisions of a company. All right? And candidates, when the economy is facing a slump, it would not be advisable to go for an expansion program, because an expansion program would call for sourcing of financing, say, from debt. So when the economy is not doing well, when the economy is on a downtrend, then the finance manager should avoid investing in new projects. The finance manager should do what? Should shy away. The finance manager should avoid expansion programs. Okay? State of economy. Now, on the other hand, candidates, when the economy is experiencing an uptrend, then the finance manager can opt for trading on, say, equity. Why? Because larger profits are assured. When the economy is doing well, then the finance manager can choose in raising capital through equity, because the profits in such an economic state of affairs, profits are assured. But in terms of downtrend, then the stress should be on internal financing. When the economy is in a slump, then it's not advisable to seek financing from external sources, because internal sources of capital are cheaper than the external sources. So when the economy is, a company is operating in bad times, okay, in times of downtrend, then the stress should be on internal financing. And again, candidates, during an uptrend, during what? During an uptrend, higher dividends can be declared. Higher dividends can be declared. But during a downtrend, then a conservation of cash is necessary. And therefore, strict dividend policy should be followed. Do you understand? Do you understand, candidates, how the state of the economy can affect financing decisions? I'm saying here that during uptrend, the company may make profits. The company can generate profits, and profits we know are can be used to pay dividends. So during uptrend, then the company will not, when the economy is doing well, then that means that the company can declare dividends. But when the economy is not doing well, the company should, instead of paying dividends, the company should have what we call a conservative dividend policy. A conservative dividend policy is where now a company shies away or fails to declare dividends. Instead, the earnings are used to finance the company's internal projects. So the state of economy, we've said here that we have when there is a uptrend and downtrend. All right? Uptrend and downtrend. So during the uptrend, the company can develop a liberal dividend policy. But when there is a downtrend in the economy, then this should be, the company should develop a conservative dividend policy. So you can see how the state of the economy can affect financing decision of a company. When there is an uptrend, when the economy is, say, experiencing growth or recovery, during that time, the company may have earnings. And given that the company has earnings, then the company can have a liberal dividend policy. Liberal dividend policy means that the company can declare dividends. But when there is a downtrend, when there is a slump in the economy, then during that time, a company is advisable to conserve the earnings by developing a conservative dividend policy where dividends are not paid, but the earnings are used to finance the projects of a company. So you see, these are decisions that affect the financing of company projects. Okay? So the state of the economy, which is a macroeconomic condition, has an impact on financing decision of a company. We've said that macroeconomic conditions are conditions that are beyond a company, are conditions that a company cannot control. A company may not have control over the state of the economy, but these macroeconomic conditions directly affect the financing decisions of a company. So the state of economy, candidates, can also be denoted by the structure of capital and money markets. All right? The state of the economy can also be denoted by the structure of a company and the money markets. And if the capital market is well developed, having a multitude of financial institutions and venturesome investors, the finance manager will find it easy to select the proportion mix of capital structure. And accordingly, financing decisions will be broader. Financing decisions will be what? Will be broader. Because the finance manager can manage with a comparatively lower amount of cash Why? Because he or she can get funds whenever the company needs the cash. Do you understand? The state of the economy, I'm saying, candidates can be denoted by the structure of capital and money markets. All right? The state of the economy can be denoted by the structure of the capital and money markets. These are two markets, capital markets and money markets. Capital markets are markets where long-term securities are traded, whereas money markets are markets where the short-term securities or instruments are traded. So if the capital market is well developed, having many financial institutions and many venturesome investors, then the finance manager will find it easy to do what? To select a proportion mix of capital. And financing decisions will be broader. Other than equity, there could be markets for derivatives, market for other forms of equity, debentures, equity, preferred shares, derivative instruments like the futures, the contracts. So if the market is well developed, then the finance manager will have a broader market to source financing for a company. And such a manager can comparatively can manage with lower amount of cash. If cash is readily available in a developed capital market, and a finance manager can easily get money as he or she desires, then it's possible for the finance manager to work with the lower amount of capital or cash. Why? Because he or she can easily get money when the money is needed. So candidates, that's a very important point, because the state of the economy is denoted by the capital and the money market. But on the contrary, where the capital market is not well developed, where it's not easy to raise long-term funds, for instance, then the finance manager should work towards having enough equity, all right, long-term funds within the company, because of the easy availability of capital in the capital market. All right? So candidates, the dividend policy could also be broader in such cases. I'm talking about the case where the capital is easily available to a finance manager. In such a case, the dividend policy will be liberal, because the finance manager will not necessarily have to rely on the earnings of the firm to declare dividends, or to rely on earnings to finance the projects of a company. Where capital is easily available, then it's easy now to have, say, a liberal dividend policy. Shareholders can be paid easily without weighing or checking whether capital will be availed when needed by the finance manager. Right? Capital and money markets. The next macroeconomic condition is number 2, government policy. Government policy. Now, apart from the state of the economy, government policy is also significant in influencing corporate financial decisions. Almost all governments intervene in businesses, what we call state intervention or state regulation. It is found in almost all countries. And therefore, the corporate investment decisions are governed by the nature and the extent of state regulations. We've even here in Kenya had government having interest caps. The government recently put in place a capping on interest rate, and this has a direct impact on financing decision of a company. When a government caps an interest rate at, say, 14%, we saw in Kenya it had an impact on financing decisions, on the loans that are given to companies and so on. So government policy, which is done through a regulation, when the government puts in place a regulation of the conduct of businesses, that will have an impact on the financing decision of a company or a firm. And government policy is beyond the control of any firm, because this policy affects all the companies in a certain industry. A firm may not have control over government policy, yet government policy has a direct impact on the financing decision of a firm. So candidates, these are two macroeconomic conditions and 5 microeconomic conditions. These are the factors that affect the financing decision of a firm. If you are asked a question, say, and I'm going to give you an assignment. Explain 7 factors that may influence financial decisions of a firm. That is your today's assignment. Thank you for your time. I hope to meet you. In our next lesson, we will continue to study financing decision. Thank you. God bless you. Bye-bye. Hello and welcome back to the Advanced Auditing and Assurance lesson. In our today's session, we are going to study the role of audit committee in the audit process. This is the last lesson under the topic audit evaluation and reviews. We've so far covered audit assertions and how to identify relevant assertions during the audit process. We covered the subsequent events. We looked at the going concern assumption as a financial statement risk. We studied related parties. Under related parties, we looked at the risks associated with related parties, the process of identifying related parties by management, disclosure of related parties in the management representation letter and the financial statements. Another subtopic under this topic is drafting management representation letter. We also did look at the group audit, the joint audit, and the component audit. We learned how to prepare the group reporting instructions to component auditors. In subtopic number 7, we looked at the analytical reviews. In number 8, we covered evidence and testing considerations. In subtopic number 9, we looked at using the work of experts such as tax experts, valuers, lawyers, and so on. In number 10, we covered 4 areas under the company audit. The first one being the audit of financial statements. Number 2, audit of banks and non-banking institutions. Number 3, audit of general insurance companies. Number 4, we've covered the audit of cooperative societies. Number 5, we did the points to consider when auditing the taxation laws. In our last session, we looked at other special audit assignments. Today is a last lesson in audit evaluation and review, which is the role of audit committee in the audit process. The audit committee candidates plays a crucial role in the audit process. It does what? It plays a crucial role in the audit process. The audit committee may have other roles, but it also has a crucial role in the audit process. It serves as a key oversight mechanism to ensure that the integrity and the effectiveness of the organization's financial reporting and auditing activities. So, what are the primary responsibilities of the audit committee in the audit process? That's what we are going to study in our today's lesson. And therefore, by the end of this lesson, you should be able to explain the role of audit committee in the audit process. We are going to study several roles. One is independence and objectivity. A role related to independence and objectivity. Now, candidates, an audit committee is a committee that is set up by the board of directors, and the members who sit on the audit committee are non-executive directors. An audit committee consists or should consist of independent directors who are not involved in the day-to-day operations of the organization. Why? Because such independence ensures that the committee can provide unbiased oversight. Such committee can challenge management's actions when necessary. So that's one important role of an audit committee: independence and objectivity. Another role that the audit committee plays in the audit process is the appointment and oversight of the external auditor. The audit committee appoints the external auditor. The audit committee also oversees the external auditor. The audit committee is responsible for the selection and the appointing of the external auditor. This committee also monitors the auditor's independence, monitors the auditor's objectivity and performance, and that includes reviewing and approving the audit engagement letter, discussing the scope of the audit, and evaluating the adequacy of audit fees. That's the second role of audit committee in the audit process. 3, financial reporting oversight. Financial reporting oversight. The audit committee reviews and provides oversight of the organization's financial reporting process. They ensure that appropriate accounting policies are followed, significant financial reporting issues are addressed, and financial statements are prepared in accordance with applicable accounting standards and regulatory requirements. That's the role of the audit committee. Number 4 is a role related to internal control. and risk management. Internal control, and risk management. Internal control and risk management. The audit committee assesses the effectiveness of the organization's internal control system and also the risk management processes. This committee reviews the adequacy of internal controls to safeguard assets, to protect the company against fraud, and also to ensure the accuracy of financial reporting. And that may include monitoring the implementation of recommendations from internal and external auditors. 5. Communication with auditors. Now, an audit committee maintains regular communication with the external auditor. And through this communication, they discuss audit plans and findings. Through this communication, they address any concerns or issues raised by the auditor and ensures that management takes appropriate actions to address identified weaknesses and deficiencies. Communication with the auditor. Number 6, whistleblower protection. Whistleblower protection. The audit committee establishes and oversees mechanisms to enable employees and even stakeholders to report any concerns or suspected improprieties confidentially without fear of reprisal. Whistleblower protection. This committee ensures that there are appropriate measures, all right, in place to investigate and address reported concerns. Whistleblower protection. So it is the role of the audit committee to ensure that whistleblowers are protected. Number 7, legal and regulatory compliance. Legal and regulatory compliance. The audit committee monitors the organization's compliance with relevant laws, regulations, and ethical standards. This committee reviews the adequacy of systems and processes in place to identify and address legal and regulatory risks, including those related to financial reporting and auditing. They have a legal and regulatory compliance role. That's number 7. Lastly, they have a role to play in relation to reporting and disclosure. Reporting and disclosure. The audit committee provides reports. It provides recommendations to the board of directors on matters related to the audit process, on matters related to financial reporting, on matters related to internal controls, as well as matters related to risk management. This committee also ensures that the organization's financial statements and other related disclosures are accurate, complete, and transparent. So these are 8 roles of audit committee in the audit process. Number 1, independence and objectivity. Number 2, appointment and oversight of the external auditor. Number 3, financial reporting oversight. Number 4, internal and risk management. Number 5, communication with the external auditor. Number 6, whistleblower protection, number 7, legal and regulatory compliance, then lastly, reporting and disclosures. So, in summary, candidates, the audit committee acts as an independent and objective body that enhances the credibility and reliability of the audit process. And their oversight and involvement contributes to the integrity of financial reporting, the effectiveness of internal controls, and the overall governance of the organization. So that's all as far as the role of audit committee in the audit process is concerned. Thank you for attending the lesson. In our next session, we are going to begin on a new topic, which is audit-related assurance services. Audit-related assurance services. Thank you. Bye-bye. Hello and welcome back to the lesson. The subject is advanced auditing and assurance. Today we are going to study the subtopic subsequent events. Then we will consider the audit work that is done between the financial year end and date of signing the financial statements. But first of all, we're going to define subsequent events. Then we'll give a few examples of subsequent events so that you can be able to understand the meaning of subsequent events. Now, candidates, what are subsequent events? Subsequent events are events or transactions that occur after the financial year end, but before the date when the financial statements are authorized or issued. So assuming the financial year ends on 31st of December and the financial statements are authorized and issued, say, in 30th of January. So the time that lapses or the events that takes place between the date of signing financial statements and the financial year end, the events that occur, the transactions that take place between that time are what we are referring to as subsequent events. And such events can have a significant impact on the entity's financial position. It can have significant impact on results of operations as well as disclosures. And there are two main types of subsequent events. There are types of subsequent events that can be classified, let me say, into two categories. We have what we call recognized subsequent events, recognized subsequent events. That's the first category. Then there is the unrecognized subsequent events. But let's first of all define recognized subsequent events. Now, what are recognized subsequent events? These are events that provide additional evidence about conditions that existed at the financial year end. Remember, we've said that subsequent events are transactions or events that take place between the financial year end and the date of signing the financial statements. I repeat, subsequent events refer to events or transactions that occur after the financial year end, but before the date of signing the financial statements. And there are two main categories. of subsequent events. The first one is recognize subsequent events. Recognized subsequent events are those that provide additional evidence. They provide additional evidence. These are events that provide additional evidence about conditions that existed at the financial year end, all right? And require adjustments to the financial statements. And they require adjustments to the financial statements. So, number one, recognize subsequent events. These are events that happen between the date, the year end, and the date of signing the financial statements. Another feature about these events is that they provide additional evidence about the position, about the conditions that existed at the financial year end. And then they require adjustments to the financial statements. In other words, these events affect the financial statements recognition, measurement, and disclosure. They affect the financial statements. These events affect the financial statements. Now, to make you understand clearly, I'll give a few examples of recognized subsequent events. One obvious example is a settlement of litigation. Settlement of litigation. If a lawsuit or legal dispute is settled after the financial year end, then the settlement amount may need to be recognized and reflected in the financial statements. So number one, this settlement of litigation happened after the financial year end. Do you understand? It happened after the financial year end. So we are saying such an example is an example of a recognized subsequent event, which you have said it affects the financial statements, it needs to be adjusted, and it provides additional evidence. And therefore it has to be reflected in the financials. An adjustment has to be made. If a legal dispute is settled after the financial statement, but before the date of signing financial statement, then that has to be reflected in the financial statements. Number two is purchase or sale of assets. Purchase or sale of assets. Now, if a significant acquisition or disposal of assets occurs after the financial year end, then adjustments may be necessary. Why? To properly reflect the impact on the financial statements. If assets are sold or purchased after the financial year end, but before the date of signing financial statements, that is a recognized subsequent event that require adjustments to the financial statements. 3, bankruptcy. Bankruptcy. If an entity files for bankruptcy after the financial year end, but before the date of signing financial statements, it may impact the valuation of assets. It may impact the recognition of liabilities. It may also impact the presentation and disclosure in the financial statements. So such an event has to be adjusted. It will impact the valuation of assets. So if it impacts the valuation of assets, then that has to be reflected in the financial statements before the date of signing the financial statements. It's a subsequent event. Bankruptcy. I'll give more examples. Changes in accounting estimates. Changes in accounting estimates. Changes in accounting estimates. If there are changes in estimates, such as impairment or provisions, after the financial year, then adjustments should be made to reflect the changes. Do you understand? If there are changes in estimates, accounting estimates, then that's a recognized subsequent event, and therefore adjustments has to be made to the financial statements to reflect the changes. So these are recognized. Number one, recognized subsequent event. I'll discuss here number two, non-recognized subsequent events. Non-recognized subsequent events. This is the opposite of recognized subsequent events. Okay? Non-recognized subsequent events are those events that provide information about conditions that arose after the financial year end. They provide evidence about information that arose after the financial year end. And therefore, these non-recognized subsequent events do not need adjustments, do not require adjustments to the financial statements. Instead, they may require disclosure in the footnotes of the financial statements to inform users about significant events or transactions. These are subsequent events that do not require adjustments. These are transactions events that do not require adjustments. I've said these events or transactions provide information about conditions that arose after. They provide information about conditions that arose after the financial year end. The recognized subsequent events provide additional evidence of conditions that existed before the financial year end. These ones provide information about conditions that arose after the financial year end. Do you get the difference? This is after the financial year end. This one is before the financial year end. Do you get the difference? Why adjustments are required when recognized subsequent events occur. Do you understand why adjustments are not required when non-recognized subsequent events occur? So let's now give examples. I'll give examples just the way I did in the case of recognized subsequent events. Examples to help you understand clearly is issuance, number one, issuance of debt or equity. A, issuance of debt or equity. Issuance of debt or equity. If a company issues new debt or issues new equity securities after the financial year end, it may not disclose, it may disclose to inform users about the subsequent financing activities. So here, non-subsequent event, no adjustments are necessary, but the company can make it as part of the disclosures to the financial statements. Does not require to adjust. Adjusting the financial statement is not necessary, but the company can disclose it as a footnote in the financial statement. 2, natural disasters. Natural disasters. If a natural disaster occurs, after the financial year end, it may not require adjustments to the financial statements, because a disaster is something that is not expected. It's not something that is expected. So you cannot say it provides evidence, additional evidence to the existing conditions. No. It does not provide evidence to the conditions that existed before the financial year end. Does not do that. And therefore, no adjustments are required. Do you understand? It may not require adjustments to the financial statements, but should be disclosed to provide information on the significant impact of the disaster on the entity's operations or financial position. It is a non-recognized subsequent event, a non-adjusting event. 3, significant business acquisition. Significant business acquisitions. If a company acquires another business after the financial year end, then the details of acquisition, such as the purchase price and the impact on the financial statements, may be disclosed. It is a non-recognized subsequent event. No adjustments are required, but such an event has to be disclosed as a footnote to the financial statements to help users understand the effect of such a purchase on the financial statements. Significant business acquisition. Number 4 is changes in regulations. Changes in regulations. If there are changes in regulations or changes in laws that affect the entity's operations or financial position after the financial year end, such changes may be disclosed to inform users of the financial statements. Just require disclosure. Do you understand? It is a non-recognized subsequent event, a non-adjusting event. It does not need to, it does not require adjustments. It only provides information about conditions that arose after the financial year end. Change in regulations is evidence of information that existed after the financial year end. But things like settlement of litigation after the financial year end will require adjustments. Why? It's because before the settlement of litigation, there was a dispute. So if settlement is made after the financial year end, but before the date of signing the financial statements, then this has to be adjusted. The financial statements must be adjusted. As the same as purchase or sale of assets. Adjustments are necessary. Bankruptcy, adjustments are necessary. Estimates, changes in accounting estimates, adjustments are necessary. So candidates, that's the meaning of subsequent events. I've defined subsequent events. I've identified the types of subsequent events, that is the recognized subsequent events and the non-recognized subsequent events. Do you understand the difference? Do you get the difference? So candidates, before we look at the audit work done between the financial year end and the date of signing the financial statements, it's important to note that management and auditors, it is important for management and auditors to evaluate subsequent events to determine their impact on the financial statements. Because recognized subsequent events we've seen require appropriate adjustments, while non-recognized subsequent events may necessitate additional disclosure to provide users with relevant and timely information. And this ensures that the financial statements reflect the most current and accurate information available at the date of issuance. When adjustments are made, then it means that information is accurate, information is current for the users. Now let's now discuss the audit work that should be done between the financial year end and the date of signing the financial statements. Now, candidates, between the financial year end and the date of signing the financial statements, auditors perform specific audit procedures related to subsequent events. And these procedures aim to gather evidence about events or transactions that occurred after the financial year end but before the date of signing the financial statements. So we're going to look at the procedures that the auditor has to carry out during this period. Audit work. Audit work done between the financial year end and the date of signing the financial statement. The first one is inquiry. Inquiry and also what we call analytical procedures and analytical procedures. Inquiry and analytical procedures. That's the first audit work. Now, auditors make inquiries of management and key personnel regarding any significant events or transactions that have occurred after the financial year end. Inquiries, asking questions of management, asking the key personnel questions. That's the meaning of inquiry. You ask the top management of any major events that may have occurred after the financial year end. Auditors may also perform analytical procedures. These are procedures to assess whether there are any unusual or unexpected fluctuations or relationships in the financial data that may indicate the occurrence of subsequent events. So the auditor may make inquiries from the management or can carry out analytical procedures using financial data. Okay? So that after carrying out analytical procedures, you can identify any unexpected fluctuations or any unexpected or unusual relationships in the financial data. That is the first audit work. Number 2, review of subsequent events documentation. Review of subsequent events documentation. Reviewing subsequent events documentation. What are these documentations? This could be the minutes of board meetings. This could be the documentation in relation to management discussions or any other relevant records. So the auditors review the organization's subsequent event documentations, which include the minute of board meetings, the management discussions, and so on. And by reviewing this subsequent events documentation, this can help identify any material subsequent events that may have an impact on the financial statements. So candidates, after the financial year end, the auditor should carry out this procedure. The auditor should seek to review subsequent event documentation. And by subsequent events, we are talking about the events or transactions that takes place after the financial year end, but before the date of signing the financial statements. So between that period, if it's 1 month, then the auditor should check if there are any management discussions, if there are any board meetings. If there are any board meetings, then the auditor should review the board meetings, the minutes of the board meetings, so that he can find out if there are any subsequent events which may impact significantly the financial statements of the organization. If there are any material subsequent events, then that can come to the knowledge of the auditor by reviewing subsequent events documentations. Do you understand, candidates? Subsequent events documentation, there is no specific document known as subsequent event. No, these are the documentation that this is documentation in relation to events that takes place between the financial year end and the date of signing the financial statements, and that could be the minutes of board meetings and even minutes of management discussions and so on. That is a procedure, an audit procedure or audit work done between the financial year end and the date of signing the financial statements. 3, cut-off procedures. Cut-off procedures. Auditors perform what we call cut-off procedures to ensure that transactions and events are appropriately recorded in the correct accounting period. And auditors review documentation such as invoices, contracts, bank statements, and any other supporting documents in order to do what? To verify that the transactions are recorded in the correct financial year. So during this period, the auditor should carry out cut-off procedures so that the events that occur between the financial year end and the date of signing financial statements are events or transactions that relate to the financial year under consideration, so that the information is that relates to the financial year is recorded in the current financial year and not the subsequent financial year. Cut-off procedures. Number 4, evaluation of recognized subsequent events. Evaluation of recognized subsequent events is another audit work that can be carried out during this period. Evaluation of recognized subsequent events. Now, auditors here assess whether any recognized subsequent events require adjustments to the financial statements, and that involves evaluating the impact of the events on the financial statements and ensuring that the adjustments are appropriately reflected in the financial statements. Evaluation of recognized subsequent events. That's another audit procedure. 5, disclosure of non-recognized subsequent events. Disclosure of non-recognized subsequent events. Remember, we said that non-recognized subsequent events do not require adjustment, but these are events that must be disclosed in the financial statements under the footnotes. Auditors here determine whether any non-recognized subsequent events require disclosure in the financial statements, and that includes evaluating the materiality and the relevance of events and ensuring that appropriate disclosure are made in the financial statement footnotes. Six, updating risk assessment. This is yet another audit procedure, updating risk assessment. Auditors update their risk assessment and evaluate the impact of subsequent events on the assessed risks. And the auditors consider whether any new risks have emerged or whether the existing risks have changed as a result of the subsequent events. As a result of the subsequent events. Updating risk assessment. 7, management representations. Management representations. Here, auditors obtain written representations from management regarding subsequent events. And these representations confirm that management has disclosed all non-subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made. So the auditors must seek management representation letters from the management in relation to subsequent events. And in looking for or requiring or asking for these management letters, representation letters, the auditor must confirm that the management, number 1, has disclosed all non-subsequent events, and these are events that are relevant to the financial statements, and number 2, appropriate adjustments have been made And lastly, appropriate disclosures have been made. That is an audit procedure. That is the audit work done before the date of signing the financial statements. Then lastly is a review of events, This is review of events occurring after the date of the auditor's report. Review of events occurring after the date of the auditor's report. That is the audit procedure that has to be done. Review of events occurring after the date of the auditor's report. Auditors review any events or transactions occurring after the date of their report, but before the financial statements are issued. They assess whether there is need to update the auditor's report or include subsequent event disclosures. Do you understand? So these are the audit procedures that must be carried out before the date of signing the financial statements. And that is between the financial year end and the date of signing the financial statements. So that will mark the end of our today's lesson, where we've defined subsequent events. By now, you should now be able to define subsequent events. We've also identified the types of subsequent events. We've said, first of all, that subsequent events are events or transactions that take place between the financial year end and the date of signing financial statements. We've categorized the subsequent events into two. That is the recognized subsequent events, which we defined to be events that provide additional evidence of the conditions that existed before the financial year end. We also say that these are events that require adjustments to the financial statements. We also mentioned that these are events that affect the financial statements, and that's why adjustments are necessary. We've gone ahead to give examples of recognized subsequent events. Number one is settlement of litigation. Number two, purchase or sale of assets. Number three, bankruptcy. Number four, changes in accounting estimates. 1, 2, 3, 4, given 4 examples. Then we defined non-recognized subsequent events. Non-recognized subsequent events. We say that these are events that provide information about conditions that arose after the financial year end, and such events do not require adjustments to the financial statements. And we've gone ahead to give examples. 1, issuance of debt or equity securities. Number 2, natural disasters. Number 3, significant business acquisitions. Number 4, changes in regulations and laws. That we did in our today's lesson. Then we finally discussed in this lesson audit work done between the financial year end and when the financial statements are issued or authorized. We've outlined 8 audit procedures. Number 1 is inquiry and analytical procedures. These are 2 in 1. Inquiries. Making inquiry of management, making inquiry of the key personnel of any events that may have occurred during that period. The second procedure, audit procedure, is review of subsequent events, documentation. Review of subsequent events, documentation. If there are any events that occurred between the financial year end and the date of signing the financial statements, documents such as the minutes of board meetings or documents about management discussions, the auditor should review such documentation so that he can establish if there are any significant subsequent events that require disclosure or that may cause the financial statements to be adjusted. Cut-off procedures, number 3. Evaluation of recognized subsequent events, number 4. Number 5, disclosure of non-recognized subsequent events. That is another procedure that has to be carried out by the auditor. Number 6, updating risk assessment. Number 7, management representations. The auditor must get representations from management. Okay, obtain written representations from management regarding subsequent events, and these representations confirm that management has disclosed all known subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made in the financial statements. Then lastly, review of events occurring after the date of the auditor's report. The auditor also has an obligation to review the events occurring after the date of the auditor's report. And in closing, candidates, the work done between the financial year end and the date of signing the financial statement is crucial in ensuring that the financial statements are accurate, complete, and that they reflect the most up-to-date information available. This work also helps auditors identify subsequent events that may require adjustments or disclosures, at the same time maintaining the reliability and the relevance of financial reporting. And on that note, we bring the lesson to a close. Subsequent events and audit work done between the financial year end and the date of signing the financial statements. Thank you. God bless you. Hello and welcome to the lesson. The subject is Advanced Auditing and Assurance. In our today's session, we will be looking at other special audit assignments. Having done around 6 or 5 subtopics, the chapter is Audit, Evaluation and Reviews. In our previous sessions, under the audit of companies, we studied the audit of consolidated financial statements. We looked at the audit of banks and non-banking financial institutions. We studied the audit of general insurance companies. We went ahead to study the important points to take into consideration when auditing cooperative societies. In our session, we covered the audit under taxation laws. In our today's lesson, we're going to look at the factors to consider or matters to pay attention to when auditing other special audit assignments, when carrying out other audit assignments. And candidates, other special audit assignments refers to specific engagements that are outside the scope of regular financial statements audits. We know that the auditor is required to carry out audit on financial statements, but there could be other special audit assignments which you are referring to other special audit assignments. And these assignments are typically tailored to meet the specific needs and the objectives of the audit or a client, and may involve various areas of examination and reporting. In our today's lesson, we are going to look at a few examples of other special audit assignments. And the first one being the forensic audit. Forensic audit. Number one, forensic audits. This is one special audit assignment. Forensic audit. Now, these audits, forensic audits, focus on investigating and uncovering potential fraud, misconduct, or irregularities within an organization. And forensic auditors use specialized techniques to collect and analyze evidence, interview relevant parties, and provide expert opinions in legal proceedings if necessary. That's forensic audits. Then there is number two, compliance audits. This is another example of a special audit assignment. The auditor may carry out compliance audit. And compliance audits assess an organization's adherence to specific laws, regulations, and industry standards. And these audits ensure that the organization is complying with relevant requirements and may cover areas such as environmental regulations, areas like data protection, financial regulations, and occupational health and safety standards. The third special audit assignment is the internal control audit. Internal control audit. Now, internal control audits evaluate the effectiveness of an organization's internal control systems in managing risks and safeguarding assets. And these audits assess the design, the implementation, and the operation of internal controls to provide assurance that financial reporting, operational efficiency, and compliance objectives are met. That's the objective of internal control audits. Then number four, we have what we call information technology audits, IT audits. IT audits. IT audits focus on evaluating an organization's information technology systems, processes, and controls. These audits, the IT audits, assess the security, the integrity, and availability of data, as well as the effectiveness of IT governance and risk management. And it's important to note that IT audits may also examine areas such as system development, areas such as network infrastructure, and data privacy and protection. So an auditor may be asked to carry out a special audit on information technology. 5, performance audits. Performance audits. What are performance audits? Now, performance audits assess the efficiency, assess the effectiveness, and also the economy of an organization's operations or specific programs. These audits evaluate whether resources are being used optimally, whether objectives are being achieved, and whether there is compliance with relevant policies and regulations. Performance audit is another example of a special audit that may be carried out by an auditor. Due diligence audit, number 6. Due diligence audits. Due diligence audits are conducted as part of a business acquisitions or mergers. These are audits that provide an independent assessment of a target company's financial statements, operations, and also risks to help the acquiring party make informed decisions and evaluate the financial viability of the transaction. So if company A would want to acquire company B, then company A may engage an auditor to carry out a special audit known as due diligence audit, such that after which the company being unable to have information as to whether to acquire company B or not. It is an independent assessment of the target company's financial statements, operations, so that the target, the acquiring company can get more insights and make informed decisions about the viability of acquiring the target. Due diligence audit. Grant audits, number 7, is another example. Grant audits. Grant audits are performed on an organization that receive funding or grants from the government agencies or from foundations or any other sources. And such audits verify that the funds are used in accordance with the terms and conditions of the grant, and that the organization has complied with reporting requirements, and the organization, we can also say, has achieved the intended outcomes. So candidates, these are examples of special audit assignments. All right? They are just a few of many other special audit assignments. And candidates, the specific nature and scope of these assignments will vary based on the client's needs and the objectives of the engagement. And auditors who perform or conduct these special assignments may require additional expertise, may require specialized methodologies and knowledge of specific regulations or industry practices. If an auditor is to carry out an audit in information technology, then the auditor needs to have expert knowledge in IT. The same as forensic audit. Specialized knowledge is required to carry out compliance audit. Specialized knowledge is required to carry out internal control audits. Specialized knowledge is required to carry out due diligence audits, grant audits, and so on. So these are just examples of other special audits that may be undertaken by an auditor over and above the regular audit of financial statements of institutions. These just examples. In our today's lesson, we gave out examples. We'll be looking at specific ways in which these special audit assignments can be carried out. We'll be discussing in detail, particularly in our block revision videos. We'll be looking at comprehensive questions that will help us understand how to carry out audit procedures in so far as special audit assignments are concerned. Thank you for your time. God bless you. Bye-bye.
Hello and welcome to our lesson 2 of topic 2. Lesson 2 will feature the mathematical methods of cost estimation. Now, mathematical methods involve visual fit or scatter diagram, linear regression analysis, learning curve effect, and time series, among others. Now, starting with visual fit diagram or scatter diagram, this one is where you have a diagram or a graph with the variables. Let's say you have the cost here and you have the output on the x-axis, the cost on the y-axis and the output on the x-axis. Then this diagram or graph will be used to plot in a scattered way the information or the cost data, assuming that we are having the cost and we have the output. Let's say maybe it's a cost of, say, 1,000, 1,500, 1,200, 2,000, and we have the output. Let's say the output is like 15, 20, maybe we have 12, say we have 30, like that. So this kind of data, when plotted on a Cartesian plane, which is the graph, and assuming we have our coordinates in this version, then we would require to plot a line of best fit that would cut across in the most fair way. And therefore, assuming that this is our line cutting the most fair way, this being the line of best fit, line of best fit. Now, to determine the cost function, which is y equals to a plus bx, using visual fit, then we are supposed to determine the a as the y-intercept. Y-intercept is the value of x is 0. So meaning at this coordinate where x is 0, then the value of y is where this line extended will actually cut the y-axis. So this is going to be now our a. Then to get our b, which is the slope, the change in y over change in x, we can just estimate, like we can estimate somewhere this way and this way, where this would be our change in x and this would be our change in y, assuming that we take this coordinate here. So this will be our change in y. So we are going to determine the value of b, which is the slope, by change in y over change in x. We get our b. So that we are going to come and substitute, assuming that we get our a. Assuming we get our a as like say 500 or 600 shillings, and our b we get it as, let's say 20 or either say 50. So we'll have our y equals to 600 plus say 25x. Now our point of concern is this, and that's why we may not be able to do a question and determine using the visual fit, because of accuracy. Since when you are having this data scattered and you're coming up with a line, there is no format or there's no formula of coming up with this line. And therefore, most of you students will have different lines. And when you extend your line towards the y-axis, you'll have different figures, like this 600. Someone will have a 605 or 610. Someone will have a 590 or so. So therefore, we are not going to do a question using the visual fit, but I had to demonstrate to you how you would use the visual fit and come up with the function y equals to a plus bx. So this is the way the visual fit would be, but would not be able to use a question officially and come up with a function, because that would be as per my estimation. But that's how you would come up with the cost estimation function. When you come to linear regression analysis, then that time now we are going to use a formula to come up with this line of best fit. It's going to be out of a formula. Therefore, all of us, all the students will have the same line because it's out of a formula. So therefore, we would actually look at it. So this is a linear regression analysis. Now, what is linear regression analysis? So you'll say there that this is also known as least square regression analysis or least square method, which is a statistical technique that analyzes the relationship between the independent variable and the dependent variable. This method is used to develop equation that predicts the unknown value of a dependent variable from known values of independent variables. This means if you're coming up with y equals to a plus bx, then this is what we're calling the dependent variable, while this x is the independent variable. And therefore, we are saying this one is unknown, and that's why we are calling it as unknown. We're calling it as, and this one is known. When we are doing the prediction, it is this value that you want to know. And we can only know it with the assumption that we know already the independent variables. For example, the independent variable can be the output. So assuming that we know what we want to produce, then automatically we are going to determine what costs we shall incur in the production. And therefore, we are calling it as a method of determining these dependents out of the independent that are known. Then a regression equation identifies an estimated relationship between the dependent variable and the independent variables. So we say that we come up with a regression equation that's going to tell us about the dependent out of the independent, either one variable or several variables, depending whether it is a simple or it is a multiple equation. Then the equation can be simple or multiple. Now, when the equation include one variable or one independent variable, then we call it a simple regression. But when the equation has more than one independent variable, then we call it as a multiple regression. So in this case, when we talk of simple, this is like a simple regression, then we mean that we are having y equals to a plus bx. That means one independent variable. And we can say here that where, so y would be the dependent variable, x would be the independent, then a would be the y-intercept, this y-intercept means constant. That is value of y when x equals 0, while b is the slope, or what we call the gradient, or even what we call the coefficient of x. That is change in y over change in x. We can also get it through changes. If we have the data for x and y, then you can say the change in over change in x. Now, we are having one independent variable. We are calling it a simple regression. But if you are having like a multiple regression, then this means we are having more than one variable like this. We have y equals to a plus b1 x1 plus b2 x2 up to bn xn, depending on the number of independent variables we have. So you see, we have 1, 2, and several up to xn. That means we are having more than one independent variable. That is what we call multiple regression. But this is where we have one independent variable. That is simple regression. So starting with the first one, which is simple linear regression, where we have said that we use one variable which is independent. So we can say that this method determines mathematically the regression line of best fit. This line of best fit is y equals to a plus bx. This is the one that is going to give us this line that we were estimating when we are doing visual fit. So we'll use the formula there. And then it is based on the principle that the sum of squares of the vertical deviation from the line established is the least possible, that is less than the sum of squares of the vertical deviations from any other line that may be drawn. This is what I mean. That if, for example, we are having this as our line, let's say this is our line, which is now the regression line. We are saying that this regression line is the one that is going to give us the least, if this is our value here, the difference between these two, the line and the variable, which is, this is now our coordinates. That difference we are saying is the least possible. This is least possible deviation. And this deviation, we can have it as, that is, summation of, so let's say y minus y predicted squared. This is what I'm calling the least square method, that this one is minimum. We ensure that the difference between this value, this coordinate is our y, while this line, which is a regression line, we are referring to it as y predicted. That's why the difference between the 2 points, we are saying being the deviation should be as minimum as possible. And that's why we are calling it as least square method. So least square means that square of the difference should be the minimum possible. Now, when talk of simple linear regression, we can have the official equation, the form of the equation. So the form, which is general form, is given as y equals to a plus bx plus e, where we had already indicated that y is the dependent variable, x is the independent variable, a is the y-intercept, which is constant, or the value of y when x is 0, and then b is the slope, or the gradient, or the coefficient, which is determined by taking the change in y over change in x. This e, it is for any error that may not be explained. So we can say that where this e, or else let me have it as just small letter e. So e represents the error term. Now error term means, as we are doing our prediction, our regression line may be erroneous or either may not estimate with accuracy. And therefore, that bit which may not be explained by the regression line is going to be explained by an error. That one we are putting here to ensure that our y is now explained fully by the whole of this together. But without that e, then that means that our y may not be explained by only this bit, unless otherwise under accurate conditions. But in most cases, we have that error. That's the position. Now, these a and b that are constants, we can determine them here. So, determination of parameters a and b. How determine these two parameters? They are constants anyway. They are constants. Now, we determine them officially using formulas like this. We can have Roman 1. We have this being our regression equation. We can use what we call simultaneous equations, where the first equation we can sum up our regression line. Like now we sum up this is y, we sum up it, it's going to be summation of y equals to, we sum up this a, now a being a constant, and if you're having such kind of data and determine that this a is 600, which is a constant, then it means inside here you have 600, here you have 600, here you have 600, and even here you have 600. That tells you what? Instead of us summing up the 600 that way, we can just take that 600, which is constant, and we multiply by the number of the data items. So that means instead of us summing up that way, we normally sum up this way. We take n, a standing for the 600, and then n standing for the how many number of data we have. Then plus, we sum up this x, so it will be a b, then summation of x, b summation of x. Then that's the first equation. The second equation to form the simultaneous equations is where you multiply the regression line by x. So this y times x will give us summation of xy. Then this a times x will give us a summation x, while this bx multiplied by x will give us b summation x squared. That is how we can obtain the two simultaneous equations, and when we substitute the values here, we'll be able to get a and b, which are the constants. Alternatively, we can have these derived formulas. This is derived formulas or formulae. This way, we can have b direct. B is given as n summation xy minus summation x summation y. You divide by n summation x squared minus summation x. You square it on this formula. That will give you b. Then a, we can have it as summation y minus b summation x. You divide all this by n. Or you can have this way, that it is y bar minus b x bar. This means y bar is the average of the y, which means summation y divided by n. You get it as y bar, as a mean. Then minus b. Then this x divided by n is x bar. So if you have the values which are averages, you can still substitute them here and you get your a. Otherwise, this is also a formula. So these two approaches, either simultaneous equations or derived formula, this one can be used and we get our a and b parameters, which we are going to substitute in our equation, and that becomes our regression line. So we will use this an illustration to understand and come up with this summation of y value, xy, x, and even x squared using an illustration question. Now, before I give the question, let me just give some assumptions, then we do a question to calculate. There are some assumptions I'll give. The assumptions of linear regression analysis, number one, is that there is linearity. That means the dependent variable and the independent variables are related in a linear way. Then number two, the independent variable, which is x, is assumed to be known, while the dependent variable y can be determined from that known value of x. Then number three is that the error term is assumed to be normally distributed. Error term is normally distributed. And number four is that the error terms have a zero mean. So they have a zero mean. And next is that the error terms have constant variance. They have constant variance. Next one is that the observations and the error terms are independent, meaning no serial correlation or what we call autocorrelation. That there is no pattern of the observations, neither do you have pattern of the errors. Then last one is there is no significant relationship amongst the independent variables, meaning there is no multicollinearity. Now this means that if you are having more than one independent variable, they should not be related at all. So you should have a very low degree of correlation. Now later we'll do some tests concerning these assumptions to see whether they hold on a particular question. But meanwhile, we'll do a question to understand how to come up with the regression line before we come to evaluation. So the question is a December 2009 of Advanced Management Accounting, previously known as Management Accounting. Question 1, December 2009, question 1, part A. The question reads that Zawadi Limited, a manufacturing company, is in the process of preparing its budget for the upcoming production period. The following data relates to the company for the year ended 30th of November 2009. You are given the year column, the month column, the machine hours column in thousands, and the electricity expense column in shillings thousands. The year is 2008, then 2009, down up to the month of November. The month column, we have December, January, February, March, April, May, June, July, August, September, October, and November. So if I read across, then the first year, which is 2008, the December month, the number of hours are 51, while the cost is 960. The year 2009, January, 45, 930 as the expense. February, 51 hours, and we have 930. March, 58.5 hours, and then 885 shillings. April, 63 hours, then 750 cost. May, 48 hours, 795 shillings. Then June, 39 hours, 750 cost. July, 39 hours, 750 cost again. Then August, 46.5 hours, 798 shillings. Then September, 52.5 hours, 825 shillings. October, 64.5 hours, 870 shillings. Then November, 72 hours, then 1020 shillings. The total annual and monthly average expenditures for the year ended 30th of November 2009 were as follows. You are given the machine hours. Annual total machine hours are 630,000, while electricity expense is 10 to 60. 60,000, which is 10,260,000. Then average, monthly average machine hours is 52,500, while electricity expense is 885,000. Then required, estimate the fixed and variable elements of the electricity expense using 1, the high-low method, and then 2, the least squares regression analysis. So high-low method and least square regression analysis. And that is the end of the question. Now, in order for us to use high-low method and also the linear regression, as per the question, requiring us to use the high-low method, we'll have it simply this way. High-low method. We'll have it the way we did previously in the lesson 1, that we took a summary of this being machine hours and this being electricity. So we want to use Roman 1, which is high-low method. So we have high and we have low. These are points, high, low, and high and low points. So in our case, if you check from the question, then we have the highest point of the hours is in November, which is hours are 72, while for the low is the low is 39. Low is 39, so 39 hours. While the cost, the highest is 1020, while the low for the cost is 750. So with this now, we are able to work out this y equals to a plus bx. So b we know is the change in cost over change in hours. So change in cost will be the 1020 minus 750. We divide by 72 minus 39, which is going to give us the difference of 1020 minus 750, which is 270. We divide by 72 minus 39, which is 33. So this when you divide, you'll get 8.18. So this will get B as 8.18. Then you substitute this one the way we did using one of the pairs. We can take like the high pair. We say here that therefore 1020 equals to A plus 8.18 in bracket 72 hours. So this is 1020 equals to A plus the 8.18 times 72 will give us 588.96, which in actual sense this A will give us an average of, you subtract from 1020, this would give us 431.04. Now that means we are told to come up with the fixed and the variable. So you can say that therefore we have fixed electricity cost. This is shillings 431.04. That is in full shillings 431,040. In full shillings 431,040. Then the variable cost. So variable electricity cost. This is now the shillings 8.18. This is per hour, per machine hour. So you are asked to use high-low methods to come up with the fixed electricity cost and the variable electricity cost. So we have the 431,040 in total, and we have the 8.18 per machine hour. That's all about high-low. Then we go to linear regression analysis. So linear regression analysis. where we require to use the formulas, which the formulas have indicated there. So I've indicated the formulas, so you just need to substitute them. So the formulas are as per what I gave, either the first one or the second one. So at this level, you would prefer to use the derived formulas, where we can get B directly and we can get A directly. The only difference, or the only activity or task ahead, is to determine the values of x squared, the values of x, values of y, values of x, y, and all that, so that we can be able to use these formulas. So in this case, we'll have to have some columns for us to have these values. So this being the first question, or the first illustration, I'll have the question, all the columns under the values. Otherwise, later we'll be using the calculator to give us the values. So we are going to have this way. So machine hours would represent our x, electricity is going to be our y, then we are going to have x, y, we have, and even you have x squared. So if we space them, we'll have x, we'll have y, we'll have x, y, and we'll have x squared. So if you are to indicate these values, so like if it is a machine hours, we are having 51, 45, 51 again, 58.5, we are having 63, 48, 39, 39, 46.5, 52.5, 64.5, and 72. These are the values of machine hours. Then to get the electricity cost is as what I had given. This we have 960, 960, 930, 930 again. We have 885, 885, 750, 795. We have 750 here, 750. Again, we have 785. 95, we have 825, 825. We have 870. We have 1020, 1020. Then to get the values of x, y, we'll just need to multiply x and y. We'll have this way, 51 times 960, which is 48, 960. My values, I'm storing them as I indicate. I'm storing so that I can have the final answer here. I am having 45 times 930, 930, which is 41, 850. 51 times 930 again. This is 47, 430. 58.5 times 885. This is giving me 51, 772.5, 2.5. Then you have 63 times 750, 750, which is giving me 47, 250. Then 48 times 795, which is giving me 38, 160. Then 39 times 750, 750. This is giving me 29, 250. Then 39 again times 750. This is giving me 29, 250. 46.5 times 795. This will give me 36, 967.5. 52.5 times 825, this will give me 43, 312.5. Then we have 64.5 times 870, this will give me 56,115. And lastly 72 times 1020, this will give 73,440. So this, when you add, I just need to recall my memory, and it is 543,757.5. That is it. Then, that being my values of xy, to get the values of x squared, I just need to square these values. So I'll be squaring as I store. So I'll be having 51 squared, this is 2601. 45 squared, I'll be having 2025. 51 squared is 2601. 58.5 squared is 3422.25. 63 squared is 3969. Then 48 squared is 2304. 39 squared is 1521, while 39 squared again is the same figure of 1521. 46.5 squared is 2162.25, while 52.5 squared, this will give us 2756.25. 64.5 squared, this shall give me 4160.25, while 72 squared, this will give me 5184. When I recall my memory on the calculator, which it will give me 34,227. So that means if I need again to get these totals here for y and for x, I'll add the columns, and the columns would give me, I am having 51 plus 45 plus 51 plus 58.5 plus 63 plus 48 plus 39 plus 39 plus 46.5 plus 52.5 plus 64.5 plus 72. That would give 630. 630, which was even provided in the question. In the question, you were given the totals, so 630, while this one would give us 10 to 60. As per the question, you were given those values in thousands. So that, or those are the values we want in our formulas, which we have already our summation x, summation y, summation xy, summation x. So this is now our summations. So if you were to substitute now this in our equations here, then you will have this. So we use the derived formula approach. So this being our formulas, we need to now to substitute. So we need b equals to sum n summation xy minus summation x summation y, divide by n summation x squared minus summation x u square. So we can have it this way now. B equals to n is counting how many they are. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So there are 12 months. So 12 in bracket xy. Xy is this, which is 54, 37, 57.5 minus x and y. Summation x separately, 630 times y separately is 10 to 60. All this, if you divide by n summation x, so n is 12. Summation x squared from the table is 34,227 minus x summation x alone, which is 630. You square it here. Square it. So in our case, on the numerator, so this you can calculate once. On the numerator, you can have 12 times 54, 37, 57.5. Then you subtract 630 times 10 to 60. This is going to give me 61 to 90. When you divide by, we have 12 times 34,227 minus 630 squared. This will give me 13,824, and therefore the final answer, which I take 61,290, I divide by my answer here, I'll get 4.43. That is our B, or the variable cost. Then I substitute this one here. I can have it as A equals to, we have the formula as summation y minus a B summation x, all this divided by n. So that means summation y, which is 10 to 60 minus b, which is 4.43, we multiply by summation x, which is 630. So this one, we can divide all these by n, which is 12. So this one will give us 10 to 60 minus 4.43 times 630. This will give us the 7469.1. I divide by 12. So this will give me, divided by 12, this will give 622.425. Since we have our B and A, we can now substitute them in our equation, which is y equals to a plus bx, this one, so that you can have. And even before we substitute, since we were asked to determine the fixed electricity and the variable electricity, you can have it this way, that therefore fixed electricity cost is actually shillings 622.425, or in total shillings 622,425 in total. It's like that. Then the variable. So this is variable cost is going to be shillings. It was how much? It was 4.43 per machine hour. Per machine hour. So if you were to come up with an equation, even though not asked, an equation, then that equation, the cost function that is, would be therefore y, which now we can say is our regression line. Our regression line would be y predicted, because we'll be using it to predict the future cost, will be equals to 622.425 plus the 4.43x. This means that should we want to predict for the next month, let's say like December 2009, then we have the number of hours, we'll just come and substitute here, and we get our total cost. Now, most importantly, to distinguish between the high-low and the linear regression and see the accuracy of it and which is most appropriate, first of all, we had the assumption or even the limitation of high-low that it uses only 2 points and ignores the rest of the data, meaning we cannot rely on the estimate of fixed and variable. And that's why you see the fixed is 431. Fixed was 431 point, while this one is 622. That means high-low, the fixed cost is underestimated, while the accurate one would have been 622. Then the variable cost, this is actually 8.18 variable cost, 8.18 per every hour, while this one is 4 point. This being the accurate one, automatically that means that the high-low variable cost is overstated. That means variable cost is overstated, fixed cost is understated. That will have an effect if we were to substitute next year's or next month's number of hours. So this regression is taken to be more accurate as compared to the high-low methods. So we have come to the end of lesson 2, that we have featured the mathematical methods, 2 of them, the visual fit diagram, which we did not do a question actually, but I explained how that line of best fit would be established, but there would not be any formula to get that line. But in this regression, the line is going to be estimated this way, that you have estimated where the y-intercept will be, and also where the gradient now would be 4 points. So if you were to draw that line, we would have the same line all of us, because we already have the values and we just substitute. That is the beauty of regression. Even though it is going to be tedious coming up with these, though we can also use there's a way we can use a calculator and have these values very fast, which I'll show you in lesson 3. This is taken to be very accurate and is reliable. We can even measure the error, the probable error. This we are going to do in the coming lesson 3. I'll show you all that together. So that is it about the regression as far as estimation is concerned. That's the end of lesson 2. We meet in lesson 3 in the same topic, which is cost estimation. Thank you, everyone.
Hello class, welcome to topic number 5, where we are looking at share capital. So this is the first lesson of this topic, where we are going to look at the following issues. We are going to describe share capital. We are also going to look at the various types of share capital that we can have. We are also going to look at the alteration of share capital. Then in this lesson, we shall conclude by looking at the reduction of share capital. The reduction of share capital. So class, we can begin on the first item, where we are describing share capital of a company. The share capital of a company will be prescribed in the company's constitution, where they describe what the share capital of this company will be. Now, capital becomes share capital if the capital is divided into units that we have previously described as shares. So if the company's capital is divided into these units that we are referring to as shares, then we say our company has a share capital. That the capital of the company is divided into units that we are referring to shares, then that is the share capital of the company. Now, the company's share capital can be put into various categories, what we are considering as the types of share capital of the company. Types of share capital. The first type that we may have is what we refer to as the registered. The registered, also known as the authorized, share capital. The registered or the authorized share capital. This, as the name registered suggests, this is the capital with which the company is registered with. The capital being divided into units that we are referring to as shares. It is also described as the maximum amount of capital that the company is allowed or authorized to issue. Hence the reference to authorized, the word authorized, meaning the amount which the company is allowed by law to issue. That authorized amount is the amount with which the company has been registered with. Just to make this note, the fact that we have been registered with a particular amount of share capital, it does not mean that in the future we may not alter, we may not change that amount of share capital. That it is possible that in the future, this company may be changing, either to increase or to reduce its registered or authorized share capital. Now, the company will be at liberty to either issue the whole or simply part of this amount that is their registered share capital. From this registered share capital, it is possible to have what we are calling the issued share capital. The issued share capital. This is also known as the allotted share capital. It is the share capital that the company has issued to the members. It is the subscribed share capital of the company. It is the amount of shares that members have taken up from the company and they have undertaken to give a consideration for. So, out of the company's registered share capital, we noted that it is not compulsory for the company to issue the whole of it. So, that part that they have issued, that part that has been subscribed for, that part that members have taken up and have committed to pay for, then it is that part that we are referring to as the issued share capital. Now, where this is part of the registered share capital, there is a balance that remains, which we are referring to, number 3, as the unissued share capital. The unissued share capital. That this is that part of the company's registered capital that members have not taken up, that the company has not issued. So this can be the subject matter of future issuing of shares by this company. Now, I would want us now to concentrate more on this issued share capital in our 4th type. Out of the issued share capital, we can have what we call the called up share capital. It is usually a portion of the issued share capital. If class, you can recall from our previous topic where we talked about calls on shares, where the directors were empowered by the articles to make a demand that members pay part of the shares that they have taken up in the company. This is the subject matter, or rather this is the capital, the type of share capital on the basis of which calls have been made. That it is that part of the issued share capital that the company directors have made a call in respect of. It is a portion, or it could be the whole of the issued share capital that the company has already made a demand to the holders of those respective shares that they make a payment in respect of the shares they have taken up. Still on the calling of shares, we may also have a portion of the issued share capital that we are describing as uncalled up share capital. Uncalled up share capital, where we are saying that this will be that portion of the issued share capital that the company directors have not demanded. The company directors have not requested members to make payment for. So if the issued share capital, in respect to the issued share capital, if the whole of the issued share capital has not been demanded for to be paid, then the balance will be the uncalled up share capital. Then, on this called up share capital, we can have what we are referring to as the paid up share capital. the paid up share capital. If it is not paid up, then we have what we are referring to as the unpaid up. The unpaid up share capital. The unpaid up share capital. That in respect to the amount that the directors have called up, that which they have already received, then it is referred to as the paid up share capital of the company. This is actually what the company has. It is the money they have actually received in respect of the shares that they have issued. Then there is that part that we have already demanded that members pay, but we are yet to receive. The company is yet to receive that part that they have demanded that members pay in respect of the shares they have. That part not yet received but demanded is referred to as the unpaid up share capital of the company. Now, class, we have some very special category of the uncalled up share capital that we refer to as the reserve capital, also known as reserve liability, It is a portion of the uncalled up capital. It is a portion of the uncalled up capital that the company, by a special resolution, resolves that they will not be calling that part except in the case of a winding up. Now, the idea behind not calling up this amount of capital is seen as a way of securing creditors. It gives assurance to creditors that there is still some amount of capital that members are liable to pay towards their shares, that in the event of an insolvent winding up, then there is some faith to creditors that there is still some portion of capital that the members have not yet paid up and are committed by a special resolution that will not be capable of being called up except in the course of winding up a company. So if we could describe the interrelationship between these categories, then you could have something like this, that if this were to be considered to be the registered share capital of the company, then this registered share capital of the company can either be the issued or the unissued share capital of the company. Then in respect of this issued share capital, we may have this as the called up share capital. Then we have the uncalled. Then we have the uncalled up capital of the company. Then in respect of this called up, then we have what we are describing as the paid up capital. Then we also have that part that may be unpaid. That part that may be unpaid up. So this small diagram can be very helpful to describe the interrelationship between or amongst these various categories of share capital that we have described. And it is in respect of this part, that is the uncalled up capital, that we now create our reserve capital. That it is a portion or the whole of the uncalled up capital that the company resolves by a special resolution that we will not call that part unless we have a winding up process going on, where that part is seen as securing the interest of any creditors who may have a claim against this company in case of an insolvent winding up of the company. So class, these are the various types of share capital that we may have. Now, I want to look at the possibilities of a change alteration of share capital. Alteration of share capital. Now, if a company would have this sort of scenario, that we have been registered with a capital of 1 million, let that be million Kenya shillings, and that 1 million Kenya shilling is divided into 100,000 shares, where the value of a share would be shillings 10, this being the capital, and these are the units that the capital is divided into, then this is the value per unit. Alteration of capital will refer to any transaction that will have the effect of increasing or reducing this capital. Any transaction that will have the effect of increasing or decreasing the units that the capital is divided into, or any transaction that has the effect of increasing or decreasing the value per unit. So these transactions could include the following. So ways of altering share capital. Ways of altering share capital. So the following transactions can be good examples of how capital can be altered. One of them would be redemption of preference shares. So these have to be the sort of preference shares that are redeemable that we have previously looked at and in our previous topic. We could also issuing of additional shares. Issuing of additional shares is a possibility. We also have possible transactions like a conversion issue, conversion of debt to shares. We can also possibly have consolidation of shares. The reverse is also possible, the subdivision. It is also possible to have a subdivision of shares. It is also possible to have a subdivision of shares. And other transactions like diminution of capital. Now, what is happening here? What nature of transactions do we have and what effect are they going to have as far as alteration of capital is concerned? Now, if part of our share capital was represented by redeemable preference shares, where redemption is the aspect of the company buying back that portion of shares that is the redeemable preference shares, then it would have an effect of ultimately reducing our capital and the number of units that we have as our issued share capital when the company buys back or redeems the redeemable preference shares. Now, we will have some conditions relating to the redemption of preference shares. For instance, the shares themselves have to be issued as redeemable, that they have to have that fact, that right given to the issuing company that the company can buy them back. It will be a requirement that these shares should be fully paid, that no redemption will be done for partly paid preference shares. That companies may be issuing new shares so that the consideration they get for the issue of the new shares is applied to the redemption of the preference shares. Otherwise, where the redemption is not out of a fresh issue, then it can be redeemed out of reserves. We can have the redemption of preference shares being done out of the capital reserves of this company. We also have this second transaction that has the effect of altering the company's share capital, which is issuing of additional shares. So where our capital was presently 1 million divided into 100,000 shares, this company may choose to increase its share capital by issuing additional shares. So they could be issuing an additional 100,000 to take its share capital to 2 million. The transaction will have the effect of we now have an increased capital with increased units of shares. It is also possible that we can have this third transaction where debt is converted into equity or converted into shares. This will be in respect to particular debt instruments, let's say debentures, that they were issued carrying the right to convert into equity. So when such a transaction happens that we have debt converted into equity in respect of shares, then the effect is that we have added additional equity in respect of shares. It is also possible that we can have a consolidation of shares. The consolidation of shares would be where we take a cluster, a number of shares, and then convert them or add them up into a single share, resulting into a share of a bigger value. For instance, if this company were to consolidate all its shares to take up two 2 shares to form 1, then we will have our shares reducing from 100,000 to 50, where the value of a share would be 20. The company would have consolidated the shares, merged them up, 2 to become 1, where now the number of shares, the units drop by half to 50,000, then the value per share goes up from 10 to 20. Now that's a consolidation. The reverse is the subdivision of shares, where we have the present value of share being the present shares being divided into smaller units. For instance, if our shares were to have every share be divided into 2, then we will have our number of units increasing from the present 100,000 to 200, where the value per each unit now falls from 10 to 5. Now that's a subdivision of shares. All these transactions have to be authorized by the Articles of Association, and as you note, they are all resulting into a change or an alteration of the company's share capital. Let me discuss the last of the issues in this lesson, and that is the reduction of share capital. Reduction of share capital. To understand reduction of share capital, I prefer we begin by asking ourselves the question why we may need to reduce. Why would we want to reduce our share capital as a company? Now, if you could trace the basis from this equation where we say that the company's capital is the equivalent of its assets less its liabilities, assuming that our company had no liabilities, then it is true to say that the company's assets is the equivalent of its assets if L is equals to 0. If our company had no liabilities, then it is true to say that the company's capital is the equivalent of its asset. This equation should be seen or should be kept true, that with reference to our books, the capital amount of the company should at all times be the representation of the value of the assets that this company has. It so happens that sometimes the company's assets may fall in value. For instance, where we have had an accident for which we have not received any compensation, then the company's value of assets may fall. Imagine in the event of a fire. We have a company building which was previously represented as the company's assets that has now been burned and destroyed, and no compensation for the same. Then we would say C is no longer equivalent to A as a result of the decline or the fall of the value of A. So where the value of A has gone down, to maintain this equity between C and A, then it may also become necessary to take down the value of C, which we are referring to as the reduction of capital. Now, to the second question, how will we be reducing this capital? What particular transactions may we carry out to end up with a resulting C being reduced? Now, one of the possibilities that we may have, which is the easiest of all the possibilities, is where the company extinguishes. To extinguish or reduce the unpaid up capital, of the company. So that part of the company's share capital that is unpaid up, that we have made a demand to members to pay, but they are yet to pay, then we can extinguish or reduce that liability, where we are simply telling members that they no longer have to pay. They no longer have the obligation to make that payment to the company. The effect is that our C reduces. We also have other possibilities where the company cancelling part of the paid up capital. Cancelling part of the paid up capital. This would be in the event where we do not have unpaid up capital, that the company's called up capital has also been paid up. Then in that eventuality, then we may cancel out a portion of that part of the company's capital that is already paid up. Then finally, we have the last of the options available. It would rarely be an option for us, but it is possible, where we have a company paying off capital back to members. Paying off capital back to members. This would be an extreme case where the company is saying we are going to pay back what we have received from members as capital contributions. Anyway, as extreme as they sound, we are saying these are possibilities that are available to the company to execute a reduction of capital. Now, I want us to look at the process that we will follow if we will need, as a company, to reduce capital. The process of capital reduction. The process of capital reduction. First and foremost, this process has to be authorized by the Articles of Association. Must be authorized. It must be authorized by the Articles. That the Articles must permit. That unless we have the permission of the Articles, we may not reduce capital. So that in a case where we have a company whose Articles do not allow, and the company wishes to, then they would have to begin a further distance where they have to amend the Articles first to allow them to reduce their capital. Then they would now begin the process of reduction of capital. So once we have secured the permission of the Articles to reduce capital, then the company will convene a meeting of members to approve the reduction. So we have the approval of the reduction. Approval of the reduction by members. Approval of the reduction by members. Now, members will be approving this reduction at a members' meeting by passing a special resolution. They pass a special resolution. The resolution is known as a resolution for reduction of capital. Special resolutions will always be supported by a 75% majority vote of all those members present and entitled to vote. So if we get this threshold of support at the members' meeting, then the resolution is rightfully passed and the reduction of capital is successfully approved by the members. Now, once we get this approval by members, then we begin a court approval process. Courts approval of the reduction. Court's approval of the reduction. So the company has to make an application through the directors to the courts to approve the intended reduction. Now, the reason why we involve the courts in the reduction process is that there are particular groups that may be adversely affected by the reduction of capital, that the courts have to confirm that the interests of these specific groups have been catered for. For instance, we are looking at the interests. We are looking at the interests of creditors. We are also looking at the interests. We are also looking at the interests of minorities. We are also looking at the interests of minorities. Remember, with a 75% majority approving the reduction, it does not mean everyone else is very happy about the reduction. There is still a balance of 25% that may be seriously affected by the reduction. So we afford them an opportunity to have their issues protected. So in protecting the interests of the creditor, the courts will be asking the company whether we have any creditors of the company that are objecting to the reduction. So if there is any objections we have from the creditors, the question is, what has the company done to secure the interests of that creditor? So the company could be saying that we have paid off all those objecting creditors, or we are providing a guarantee that all these creditors will be paid after the reduction. That is in a bid to ensure that no creditor will be compromised by the reduction of the capital. So the same will happen for the minorities. If any minorities are objecting to the reduction, then again the court confirms how the interest of such minorities has also been respected or observed by this company. So if the court is okay that the creditors' interests are not prejudiced and the minorities' interests will not be prejudiced by the reduction, the court will issue an order. The court issues an order. The court issues an order confirming. The court issues an order confirming the reduction. The court issues an order confirming the reduction. In some extreme cases, the courts will go to an extent of protecting the interest of third parties, members of the public, where they may require this company to change its name, to add to its name the words "unreduced." We may have an order that the company is to add these words "unreduced," so that if our name was previously AB Limited, the name of this company that has reduced capital may now become AB Limited and reduced. This order is to the effect that this is to be part of our name for a specified period of time, so that anybody who sees this, then they may know that we have previously reduced capital as a company. But it is not a very common order. The court will also be conscious of the adverse effects that the company may get by notice being sent that they have previously reduced their capital. So this may not be the usual case that companies will be ordered to put this or to have this as part of their name for a specified period of time. So we now have our court approval for the reduction. The next thing is that we will now have to give notice to the registrar. We will now have to give notice to the registrar that we have reduced our capital by a special resolution of members and receiving an approval of the court. So how will this registrar know that we had a meeting approving? We shall be giving them minutes of the meeting of members in which the special resolution was passed. How do they know that we received a court order approving the reduction? We shall be giving them a certified copy of the court order approving the reduction. So once the registrar has that, then they are convinced that the due process has been followed in reduction of capital. They will now finally be registering the reduction. Registration of the reduction. Registration of the reduction of capital. So dear class, that is what we are covering in this first lesson on share capital, where we have defined what share capital is. We have also looked at the various types of share capital that we can have. Then we have looked at the various transactions that constitute an alteration of the company's share capital. Then we have also looked at the process of reduction of capital, where we began by asking ourselves why we were reducing capital and how we would reduce capital, and then finally the process to be followed. So thank you very much.
Hello learner, welcome to Manifested E-Learning platform. My name is FAM Nengwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. you are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta for each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A, you can see the average right over here. And the average of what? We want to pick the average for Z term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the brackets, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD stud dev, not P, because we're not picking for the entire population. We want to picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or variance of the market. So we pick covar S, because we look at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market. So we are saying this one for G is one that you can be able to decide to lock. F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that.
because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if you were to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1 because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the topic of analyzing the financial statement, which is topic 7, and the last topic in FRA. So in this session specifically, I want us we do an illustration question, and the question I want us we do is the question which was tested in the sitting for 2021, specifically question number 3. Let's go through the question and we see what was required. So question 3 of 2021, December 2021 reads, various analytical tools are today utilized in financial statement analysis. Some of these tools include number 1, ratio analysis, number 2, trade analysis, and number 3, common size financial statement. Required in context of the statement above, describe how each of the above tool is utilized in practice. So we are given the various analytical tools, and what the examiner there was requiring is we describe, or basically we explain how those particular tools are used in what? In practice. So this is part A, which require explanation of various analytical tools, or we can just talk of explanation of financial statement analysis tools. So in that case, you're given a number of tools which are required to explain. The first one is ratio analysis. And for the ratio analysis, this particular tool here or technique, it basically entails computing various financial ratios. And in our case, we know a financial ratio is a relationship between two or more financial variables. So therefore, you can say this entails computation of financial ratios. And also we have various categories of ratios which we discussed in our first session as far as this topic is concerned. So the other tool we are required to explain is the trade analysis, which is also known as the horizontal analysis. Now, horizontal analysis, which is also known as a trade analysis, is basically analysis which is done or undertaken by a financial analyst to establish the trade, or in other terms, to establish the change, which is the increase or decrease of the various financial statement items as compared to a certain base period. So therefore, you can say that this entails establishing the trade. So in this case, the trade is the same with the change, and this change can either be an increase stroke decrease, decrease of various financial statement items, in a certain financial period or in a certain year, as compared to a base period, as compared to a base period. For example, in this case, you can be given the income statement which was prepared by the company in the year 2023. You are given various items of the income statement. For example, maybe you can just pick one, and that is revenue. You're given the revenue of the company for this year. But equally, let's assume that you're given the revenue for 2 years, not 1 year, revenue for 2 years, 2022 and 2023. So in doing this particular analysis here, which is known as the trade or the horizontal analysis, we are saying what we need to do is to establish the trade, or basically the change, that is the increase or decrease of financial statement items in a certain year compared to a certain base period. So what we do here, assuming you're given the revenue here to be 200 million, here to be 250 million. So we have an additional column here whereby we show the increase stroke the decrease, stroke decrease, and this increase or decrease will be for the most recent financial year, which is now the year 2023. And in this case, we can see the revenue for this year increased with 50 million compared now to the revenue for this year. So basically what that means is that the year 2022 will be recognized as the base period. That is the year we are using to determine whether the revenue for 2023 increased or did what? Reduced. After showing the increase or decrease, basically an increase you record it as a negative, but if it was a decrease recorded as a negative, it must be inside the bracket. And then finally, you have to express that increase or decrease as a percentage. You express that increase or decrease as what? As a percentage. For example, in this case, you take 50 million, divide that with the revenue for the base period, which is the 200 million times 100. And in this case, we can make a conclusion that the revenue for this year increased with 25% as compared to the revenue for 2022. That is now what we refer as the horizontal or the trade analysis. And basically, you repeat the entire process for all the items of the financial statement. So then we also require to explain the other tool number 3, common size financial statement. Common size financial statement. These are financial statements which are prepared by expressing all items in the financial statement as a percentage of a certain base item. So here, all items will be expressed as a percentage. So we can say this entails expressing all items all items in financial statements as a percentage of a certain base item, as a percentage of a certain base item. And here we have number one, the common size income statement. So common size income statement, this one, entails we express all items in the income statement as a percentage of revenue. So all the items in the income statement here will be converted, or basically will be expressed as a percentage of the revenue, or basically as a percentage of what? Of sales. As a percentage of sales. And then we have the common size statement of financial position. This one entails, or this one is prepared by expressing all items as a percentage of total assets. As a percentage of total asset. So therefore, that's what you mean by common size financial what? Statement. And that's what was required as far as Roman 1 of that question is concerned. And the marks which were located there were 6. So basically what that means, that explaining each of these, you are getting 2 marks. 2 marks for explaining each of those particular what? Concept, or those particular analytical tools. So let's move to part B of that question. And it reads, summarize 4 attributes of a good financial statement analysis. So the examiner here was asking about the attribute, or in other terms, the qualities of a good financial statement analysis. So let's explain those attributes. Attributes of a good financial statement analysis. So these are, in other terms, are qualities of a good financial statement analysis. And I think in our previous session we discussed on this. We have around maybe 5. We can talk of number 1, timeliness. Timeliness. And in this case, we say that the information which is provided by financial analysts, it has to be provided on time to help the users in terms of making decision. Number 2, we have understandability. Understandability. Equally, the information provided by financial analysts must be readily understandable by the users, for the users to use that information in terms of making their intended decision. Then we also talked about the reliability, and we said this information provided by financial analyst, one, must be complete. It must be what? Free from any errors, and also it must be what? Neutral. We also have relevance, meaning that the information provided by financial analyst must influence the decision which will be made by the users. Must influence the decision which will be made by who? By the users, and so on. So I think the examiner there was just requiring 4. We can just talk of those particular 4 attributes, and equally the marks which were located there were for, basically for explaining it, you get those particular, or for explaining those 4 attributes, you get a total of 4 marks. So let's move to part C of that question, and it reads, the following are extract from financial statement of financial statement from the books of Zawadi Limited. We are given the extract of the income statement for 2 years, 2020-2021. We are given the sales revenue. We are given the cost of sales, which are told approximate purchases. We have the gross profit, administrative expenses, distribution cost, profit, or we have the finance cost. Then we have the profit before tax. We have the extract of a statement of financial position, where we have non-current asset, which include property, plant and equipment, intangible assets. Current asset comprises of inventories, trade receivables, cash and cash equivalent, and then we have the total asset. We have then the current liabilities, which include trade payables, current tax payable, and then we have the total current liabilities. Then we are told to assume a 365 days financial year. From that information, the examiner was requiring we analyze and interpret the performance and efficiency of the company for the 2 years, the year which ended 30th April 2020 and 2021 using the following ratios. So in other terms, what the examiner was requiring is we compute those 5 ratios and we comment on the company's performance and efficiency over the period of 2 years, that is 2020 and 2021. So therefore, let's compute those ratios. This is part C of our question, whereby we are required to compute a number of financial ratios, and we are required to compute those ratios for 2 years. For 2 years. So we need to have like 3 columns here. The first column will be for the ratios we are expected to compute. Then we have our 2 financial years. We have 2020 and 2021. So always make sure the first year comes first for you to be able to see the trend. So the first ratio we are expected to compute is the gross profit margin. Gross profit margin. So the first thing you have to recall here is the formula. How do we compute this? We take a gross profit, we divide that with the revenue times 100. So that's how we compute that ratio. So we go back to the income statement or the statement of profit or loss. This is where we get the information about revenue and the gross profit, actually from the income statement. So the gross profit for the first year is 103,812. We divide that with the revenue, which is 476,200 times 100%. And then for the other year here, we have the gross profit, which is 117,902, divided that with the revenue, which is 701,800, and we definitely have to multiply that with what? With 100. So let's compute these 2 ratios here. We see what we are going to get. So the ratio for the first year is 103,812 divided by 476,200 times 100%, and that will give us 21.8%. What about 2021? We have 117,902 divided by 701,800 times 100%. That is giving us 16.8%. So let's move to the other ratio, number 2. Number 2, or Roman 2, we are required to compute the other ratio, which is return on capital employed, or LOCE. Roman 2, return on capital employed. This one is computed by taking, we compute this by taking PBIT, profit before interest and tax. We divide that with capital employed times 100. In terms of how we compute the capital employed, this one is computed by taking the total asset minus current liabilities, or alternatively you can take equity plus non-current what? Liabilities. So, but let first of all we get the profit before tax. The profit before tax, in other terms, is also known as operating profit. You get that from the income what? Statement. But in most of the cases, the examiner will not have given you this. Like if you check on the information which you are given in the income statement, there is nowhere we are given the profit before what? Interest and tax. So what we are given by the examiner is the profit before tax. So how do we arrive at the profit before interest and tax? So we take this profit before tax and then we add interest. The interest is the same with the finance what? Cost. After adding the 2 figures, we are going to have the profit before interest and tax. So let's do that. We take the profit before tax, 50,850, and then we add back interest, or the finance cost for that year is 7,200. That now will give us the profit before interest and tax. We divide that with the capital employed. The capital employed, I've said, you can take the total assets minus current liabilities, and actually that is a formula we are going to apply here. We take total assets. Total asset will be equal to non-current asset plus current asset, which is 18 140 plus current assets. Current asset 36 695, and then to this we less current liabilities. Current liabilities is 179 835. That's how we are going to arrive at the figure for capital employed. So we do the same for 2021. We take the profit before tax, which is 42 960. We add the finance costs or the interest, which is 10 800, and then we multiply that with 100. We divide that with the capital employed, which will be equal to total non-current asset 1881 500 plus current assets, which is 335 500 minus current liabilities 297 thousand. 297,000. Yes. So this ratio is very, very common because you can see none of these two items, the profit before interest and tax and capital employed, is provided to you by the examiner. You have to remember the formula for computing those two items. So let's compute those two, or basically compute the return on capital employed for the 2 years. So we start with the first year here. We have 850 plus 7,200. That will give us 58. We can write it here, 58,050. And then we have the denominator 18 140 plus 236 695 minus 179 835. So that will give us 107. Okay. So what we need to do, we take 58,050 divided by answer times 100%, and that will give us a 5.4%. What about the other year here? We have 42 960 plus 10,800, that is, and then we divide that with 1881 500 plus 335 500 minus 297 1,000 times 100. That will give us 2.8%. 2.8%. So that's how we compute that figure for what? For the return on the return on capital employed. So let's move to the other ratio, number 3. Number 3, we have inventory turnover period. Inventory turnover period. So the inventory turnover period, this is a ratio generally which is computed to determine on average the number of days this company was taking to convert inventory into sales. So how do we arrive at this? So we take the average inventory, we divide that with the cost of sales, and then we multiply that with the number of days in a year. So in our case, we are told to assume a year has 365 days. So how do we compute the average inventory? So we compute the average inventory by taking the opening inventory plus the closing inventory divided by 2. But we only compute if you're given a question and you're given 2 financial years like what you're given here, 2020, 2021. You only use the average figures if the examiner has provided you information or has given you the opening inventory for the first year. If you're not given that opening inventory, then for the 2 years, you use now your closing inventory as your average. So meaning that you only compute now the average in the event you're given the opening inventory for the first year. If it's not given for the 2 years, then use your closing inventory as your average. So we have the closing inventory under the current asset. In the first year, it is 81,000 times 365. And then the other year here we have 81,400 times 365. And then we need to divide that with the cost of sales. Cost of sales, we get that from the income statement. We have 372, 388 for the first year. And here it is 583, 898. So let's compute this particular ratio here. So for the first year, we have 81,000 divided by 372, 388 times 365. So that to the nearest whole number will give us 79 days. 79 days. What about the first year? 81,400 divided by 583, 898 times 365. That to the nearest whole number will give us 51 days. So these are ratio computed to show on average the number of days the company was taking to do what? To make sales or to convert inventory into sales. So the other ratio, which is number 4, as the trade receivables correction period. So how do we compute this particular ratio here? So we take the average trade receivables, we divide that with the credit sales or the credit revenue. We multiply that with this 365 what? 365 days. And equally here to compute, to determine the average trade receivables, we take the opening trade receivables plus the closing trade receivables divided that with 2. But equally, we only compute the average in the event the examiner has given you the opening receivables for the first year. So in such a case whereby you're given 2 years. But if you're not given the opening receivables for the first year, what you do, you then use the figures in the statement of financial position as your average. That will be the case in year 1 and also year 2. So where do we have the receivables? The receivables, we have them in the statement of financial position, specifically other current assets. So for the first year, we have 95, 240. We multiply that with 365. The same case with the other year, 175, 450 times 3 what? 65 times 365 times 365. We divide that with the credit sales or the credit revenue. Equally, if you check on the income statement, what the examiner has given us is revenue. And unless told otherwise, always you use the revenue in the income statement to be on credit. To be on what? Credit. There are some cases whereby the examiner may have given some information that the revenue of the company was 70% of the total revenue. Unless such information is given, you assume the entire revenue was on credit. So the credit revenue for the first year is 476,200. For this year, it is 701,800. So we compute these particular ratios and we get the final figure. So let's start with the first year, which is 95, 240 divided by 476,200 times 365. So this will give us 73 days. And then in the first year, we have 175, 450 divided by 701, 800 times 365, which will give us 91 days. 91 days. Yes, so that is it. That what is required there. And then finally, we have the other issue, that is the trade payables payment period. Okay, so let's just have it here. Trade payables payment period. So how do we compute this one? We take the average trade payables times the number of days in a year, 365, and then we divide that with the credit purchases. Credit purchases. In the event the examiner has not given you the credit purchases, what you do, you instead use now the cost of sales. But if you take on what you're given in this question, we are told in the income statement the purchases, or basically the purchases of the company were the same with the cost of sales. So therefore, let's compute this ratio. So we take the average trade payables. Average trade payables equally, we take the trade payables at the start plus the closing, and then divide that with 2. But equally, the concept I've explained here, for receivables, for inventory, we only compute the average trade payables where the examiner has given you the opening payables for the first year. If that is not given, then in year 1, year 2, use the figures in the statement of financial position as your average. We know trade payables is part of the current liability. So this is 111, 715 times 365. Here we have 204, 365 times 365, and then we divide this with the cost of sales or the purchases, which is 372, 388, and then here we have what? We have 583, 898, and then we get the final answers here. Yes, so let's compute those final answers. We start with the year 2020. We have 111, 7115 divided by 372, 388 times 365. So that will give us 109 days. 109 days. And then finally we have 204, 365 times 365 days divided by 583, 898. So this will give us 128 days. 128 days. Yes, so that is it. That basically what was required as far as that question is concerned. And by computing those particular ratios, for each ratio the examiner was had allocated 2 marks. So meaning that by doing that you get 2 marks, 2 marks, 2 marks here, and equally there you get what? 2 marks. In total, there were 8 what? There were 8 marks for computing those ratios. But you can see, as far as the computation of ratios is concerned, what is important is for you to remember the formulas. If you can't be able to remember the formula for computing these ratios, then there is no way you can be able to successfully attempt and also pass a question on computation of what? Of ratios. So that is it. That what was required as far as that question is concerned. I want to give an assignment which I expect you to attempt, and the question or the assignment is a question which was tested in the April of 2022, specifically question number 2. Question number 2. This is a question which was requiring the computation of what? The computation of ratios. The computation of ratios. Once you attempt that question, I usually encourage all my students to get these revision partners by manifested publishers. Is updated up to the latest sitting. So therefore get this. Once you attempt the question, you have any challenge in terms of answering that question, you'll be in a position to access all the solutions at the end of this particular book. So therefore, make sure you also have this particular revision kit with you. So that brings us to the end of that particular session. So once we come back in our next session, I want us to look on an illustration question which was tested in the sitting of August 2022, which was requiring the preparation of the common size financial statement.
Welcome to Manifested Publishers.
Hi learners, hope your learning experience is smoothful and you do enjoy the sessions. Welcome. In this session, we are still under the various types of derivatives, And these derivatives are of three broad categories: the forward commitments, then we have the contingent claims, and we have the exotics. Now, with forward commitment, we said this comprises of forwards themselves. We do also have the futures, and we do have the swaps, and predominantly what we refer to as contingent claims are options. For exotics, this is our subject of discussion this session, and we have previously seen that these are just variations to existing derivatives contracts. They are brought about because of the work of financial engineering. Now, the various types of exotics that we have been able to see, we have come to appreciate that there are range forwards. Now, with range forwards, we have been able to see that they help or they assist the parties there to be able to manage predominantly the exchange rate. Then we have the break forward contracts, predominantly called the Boston contract. And this one is that we can be able to defer the coupons or the payment until maturity. So they are what we can commonly call the zero cost instruments. Then we have also seen compound options. And predominantly, these are options on options. For example, a call on a call. Then we have the other category of options that we have seen called the barrier options. So with the barrier options, we have seen they either come into existence, which now becomes a knock in, or they cease to exist, which will be a knock out, and this depends on the underlying asset price reaching a particular barrier. So the underlying asset price reaching a particular barrier, reaching a set barrier. So that's how you have your barrier options. And then we also saw what were binary options. Now, with binary options, we said these are digital options. And we said that their payoffs are in discontinuous. The payoffs are discontinuous. Now, having seen that, we would like further to explore the types of exotics and look at another particular type of exotic we call the chooser options. The chooser options. Chooser options, this as the name suggests, they can be referred to as you like it. So these are predominantly called as you like it options. As the name suggests, as you like it, it means that after a specified period of time, after a specified period of time, the holder of this option, the holder of this option has the right to choose whether it will be a call or a put option. Now, in a normal option contract, at the initiation of the contract, at the setting of the contract, at the early age, or when generating the contract, is normally set whether it is a call or a put. Now, in a chooser option, the holder of that right, as time passes by over the life of the contract, then he has the right to choose whether it will be a call or a put. So it is left blank for the holder to enable them to choose. Yeah, and therefore that is why we normally say that these chooser options are as you like it. Then another category of the exotic options becomes the look back options. The look back options. Now, with look back options, we are saying the payoffs herein depend on whether payoffs herein depend on whether the maximum or minimum asset price has been reached during the life of the option. During the life of the option. So the payoffs herein depend on whether the maximum or minimum asset price has been reached during the life of the option. Now, this category of option is able to give us two subtypes because the prices have a tendency either to move up or down. So the first category is what we call a floating look-back call. A floating look-back call. Herein, what we get to define the payoff. So herein now, the payoff is the amount by which now the final asset price, the final asset price exceeds the minimum asset price during the life of the contract, the life of the option. Right? So in a floating look-back call, we are saying it is predominantly defined where the payoff amount is now by which the final asset price exceeds the minimum asset price during the life of the option. The second category is dependent on either the choice to buy, which is a call, or the choice to sell, which is a put. Then we will have a floating look back put. Now, in a floating look back put, now we are saying the payment amount is the payoff here, the payoff is the amount, the maximum asset price, the maximum asset price exceeds the final asset price, exceeds the final asset price. So the floating look back put is where by now the payoff is the amount by which now the maximum asset price will be able to exceed the final asset price. Now, the other that category that is of our interest today is what we call the Asian options. The Asian options. Now, with Asian option, in some books, they also call them the average rate options. Now, what happens with average rate options? Now, with average rate options, we say the payoff will depends on the arithmetic average, of the underlying. So now what happens is that with the Asian options, they are normally called the average rate options, whereby now the payoff depends on an arithmetic average of the price of the underlying. So the average price or options are less expensive. So they are less expensive, of course, than a standard option, and that is why attracts people. For example, let's say an organization, for example, let's say an organization is to receive a foreign currency, receive a foreign currency. The corporate treasurer or the finance manager in that institution may decide that instead of the fluctuation in the exchange rate, instead of the many fluctuations in the exchange rate, let me set the price that I'm going to buy the foreign currency, having been determined through an average. Having been determined through an average of exchange rate. Exchange rate. Having been determined through an average of exchange rate, and in so doing, the corporate manager there would have been exercising an Asian option or the average rate option. The other category of exotic option, these are the options to exchange one asset for another. Options to exchange one asset for another. So in options to exchange one asset for another, these are predominantly exchange options. They are predominantly called the exchange options. Now, with exchange options, we can see this is an option, for example, for a Kenyan investor. For example, we can see it through a Kenyan investor. If we have the option to exchange, option to exchange maybe the yen to US dollars. We have the option to exchange the yen to the US dollars. From a Kenyan investor, this is a option now to exchange one foreign currency to another. Is an option to exchange one foreign currency to another. So here we are exchange one foreign currency to another. Then also within the options to exchange one asset to the other, we have the stock tender offer. Yeah, the stock tender offer. Now, with a stock tender offer, what happens is that this is an option to exchange, the shares of one stock for another stock. So the option on a stock tender, so the option to exchange the shares of one stock for another stock. Then the other category, the last category of options, is the options involving several assets. The options involving several assets. Options involving several assets. So for the options involving several assets, these are predominantly known as rainbow. The rainbow options. What happens with a rainbow options? Now, with a rainbow option, we say that the party that is short, then that is short position, in the short position, now we say has the option to choose from a variety of, say, bonds in order to settle their positions. So in a rainbow option, it gives the party into it, especially a short position. Now, in a short position, this is the person who was selling. A short, going short, is to sell. So when you decide to sell an asset and the derivative time has come to an end, you're supposed to deliver that underlying asset at the seller. So let's say, for example, you can deliver that asset maybe through bond, isn't it? So you have a variety of different bonds to choose from, where now this seller can be able to settle their position out. And if that is the scenario, if that is the agreement, then what you'll be having will be rainbow option. Then another category within the options on several assets is a category where we call the European basket option. European basket option. The European basket option. Now, here we say that under the European basket option, the payoff depends on the value of defined portfolio. And we know in a portfolio, this is a group of assets. A portfolio is a group of assets. So in an European basket option, then herein is an exotic derivative whose payoff depends on the value of a defined portfolio, and the defined portfolio here is a group of assets. Now, having seen those categories and various many categories others in our previous lessons, this brings us to end on the types of derivatives and also bring us to end on the types of various exotics. So, as an assignment to be able to learn this concept better as an assignment, assignment number 1, explain the differences between forwards and futures. So now assignment number 2, define the following terms as they apply to exotics. Number 1, floating look back call option. Number 3, number 2, knock-in option. Number 3, stock tender offer. So for our assignment, we have 2 questions. The first question is explain the differences between forwards and futures. And second is that define the following terms as they apply to exotics. Number 1, floating look back call options. Number 2, knock-in option. Number 3, stock tender offer. Thank you.
Hi candidate, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Analysis. So in this session, I want us to start on the topic of the group account, or the topic of consolidated financial statement. And this is one of important topic in this paper, because any time you're sitting for FRA paper, there is always a question coming from this topic of the group account. So therefore, it is a very, very important topic. So as far as this topic is concerned, we're going to look on the preparation of what you refer as a group account, or consolidated financial statements. And these are those financial statements which are prepared by an entity having interest in other companies or in other entities. For example, you are told a parent company or company A has acquired some shares in company B. We say company A has interest in other entity or in company B. So therefore, what we're going to do is we are going to look on how the group account or consolidated financial statements are prepared by a company having interest in other entities, of which now the other entities or the company whereby the parent company has acquired shares, that company can either be a subsidiary or it can be an associate or a joint venture. So therefore, we are going to look on how the group account, the consolidated financial statements are prepared when the parent company has invested in a subsidiary, an associate, or a joint a joint venture, what is currently known as a joint arrangement. And by the end of the day, also we are going to look on the preparation of the branch account or something to do with the branch accounting. But to start with, I want us, we concentrate or basically we look on how the group accounts are prepared or how consolidated financial statements are prepared. Remember, first of all, you have said that those are the, or these are the financial statements which are prepared by an entity which do have some interest in other what? Entities. So in this case, we say an entity is having interest in other entities, whereby a company has acquired shares in other what? Entities. But even before we look on how to prepare those particular group accounts, to prepare the consolidated financial statement, I want us we look on definition of few terms, or basically we define some few terms. So let's start by looking on definition of terms. Terms. So the first term we have to define here is the term group. Group. When talk about the group, this refers to a group of companies, and basically a group of companies comprises of a parent company and its subsidiary. So therefore you can say a group. This is a parent company and its subsidiaries. Subsidiaries. Parent company and its what? Subsidiaries. So what is a parent company? On the other hand, a parent company. A parent company, we say, is a company having a control over another entity. Basically, a company is said to have a control of another entity if that company has acquired more than 50% of the ordinary shares or equity shares issued by the other entity. So therefore, we can say this is a company or is an entity having a control over the other entity, and in this case I've said a company will be regarded to be having a control, if that company is or has acquired more than 50% of the shares, of the other company. So assuming you're told company A acquired 50% of the, or not 50%, but rather more than 50%. More than 50% means between 51% and 100% of the shares issued by another company, which is company B. So in this case, we say that company A here is a parent company, whereas company B is a subsidiary. So, but in this case, when looking on the control, we don't only concentrate on the percentage shares. There are some cases whereby you can be told company A is the one which appoint majority of the directors in what? Company B. So if that is the case, it means that company A controls the composition of the board of directors of company what? B. And therefore this now company will be a parent company as far as company B is what? Is concerned. Equally, you can be told that company A here is the one which appoint the senior managers, or basically appoint majority of the senior managers in company what? B. So if that is the case still, it means that company A is the parent company, whereas company B is what? Is the subsidiary. So therefore, a parent company is basically that company having a control over another company. We have said a company may be having a control of another company, one, if it controls the composition of the board of directors of the other company, which is now the subsidiary, mean that if a company appoint majority of the directors in another company, it controls the other company. If a company appoint majority of the directors in another company, still is a parent company, and equally if a company hold majority of the shares in another company, it is known as a parent what? A company. So therefore, that is the other term we need to define there. The other term to be defined is the term business combination. And the business combination is the transaction, or in other terms, it is the event through which now the parent company acquires control over a subsidiary. So if you're told company A acquired like majority of the shares in company B on a certain date, so that transaction, when company A acquired a control over company B, that is now what refers as a business combination. So we say this is an event or a transaction where an investor, in this case when we talk about an investor, we are talking of the parent company. An investor, the parent company, acquires control over the investee company In this case, when we talk about the investee company, we are talking of the subsidiary company. So that transaction or that event through which now the investor or the parent company acquires a control over the investee or the subsidiary, we refer to that transaction as a business what? Combination. So the other term we also need to define here, which is the number 4, is the non-controlling interest. Non-controlling interest, abbreviated as NCI. And the NCI, this refers to the shares in a subsidiary company which are not held by the parent company. Assuming you're told the parent company here acquired 80% of the shares issued by B Limited. It means that the remaining 20% of the shares issued by this company, that is company B, they are not held by the parent company. So those shareholders who hold this 20% of the shares, we say that they are minority shareholders, and therefore their interest in company B is regarded to be a non-controlling interest. Reason being that those minority shareholders, they are not in a position to control the operating and financial decisions which will be made by this company. They are not in a position to control the composition of the board of directors of what? Of company B. So therefore, the non-controlling interest we can say is what? This is a part of equity or ordinary shares issued by subsidiary company and not held by the parent company. So therefore, this is the stake, or in other terms, it is the interest of the minority shareholders. So we are saying minority shareholders do not have the ability to control the operating and financial decisions of the subsidiary, and also the minority shareholders are not in a position to control the composition of the board of directors of the subsidiary. Therefore, their interest is a non-controlling interest. So therefore, these are some of the terms. You must be in a position to define what is a group. Group is the parent and its subsidiaries. What is a parent company? We have said is a company having a control of another company which is called now the subsidiary. The other term you must be in a position to define is the business combination and the non-controlling interest. Now, this company which is called the parent company, and which then we are saying is having some interest in other companies which are known as the subsidiaries, or basically which are known as subsidiary companies. This company is required at the end of each financial year to prepare financial statements which are known as group accounts. So therefore, the group account or the consolidated financial statement are those financial statements which are prepared by a parent company which has acquired a subsidiary, or which has acquired a number of what? Subsidiaries. Now, when these group accounts are being prepared by the parent company, they are prepared in accordance with the various accounting standards, and therefore in this case maybe you can just highlight the applicable accounting standards. Accounting standards. So which accounting standards are used by the parent company in preparing these group accounts? So number 1, we have IFRS 3, International Financial Reporting Standard number 3, and this deals with the issue to do with business combination, of which you're going to see that this particular standard here has laid down the procedures and principles to be used by the parent company in determining the goodwill arising from business what? Combination. We are going to look on that next. The other standard which is also applicable here is IFRS 10. This governs the preparation of a consolidated financial statement. Preparation of a consolidated financial statement, specifically whereby the parent company has invested. The parent company has made investment in what? In the subsidiary company. The other standard which is also applicable is International Accounting Standard number 28. This governs the preparation of a consolidated financial statement, specifically where the parent company has made investment, has invested in an associate or a joint arrangement, or basically invested in associate and joint arrangement. Joint arrangement is what in other terms we refer to as the joint venture. The other standard which is also applicable here is the International Accounting Standard number 36, impairment of assets. Impairment of assets. So therefore, these are the various accounting standards which the parent company will apply in preparing the group account or the consolidated financial statement. I want us to start by looking on the rules and principles of the first standard here, that is IFRS 3. So number one, we have IFRS 3. IFRS 3, which governs the accounting of business combination. Business combination. Remember, we have already defined what is business combination, and we have said that this is that transaction through which a parent company acquires a control of another entity, which is called what? A subsidiary. Now, IFRS 3 basically establishes the principles and also the rules of measuring goodwill arising on a business combination or arising on a business what? Acquisition. Basically what that means is that whenever the parent company acquires a subsidiary, this subsidiary can be acquired at a goodwill or basically a negative goodwill, or in other terms we refer to that negative goodwill as a gain on bargain purchase. So this standard, therefore IFRS 3, establishes the principles of how that particular goodwill arising on business combination should be what? Should be computed. So therefore we can say that IFRS 3 establishes the principles of determining a goodwill arising from business combination. Business combination. So what is goodwill? Goodwill, basically this is the difference between the purchase consideration which was paid by the parent company and the net asset, or basically the fair value of the net asset which were acquired. So we say goodwill is the difference between purchase consideration paid and fair value of net assets acquired. Fair value of net assets acquired. So any difference is actually a goodwill. So therefore goodwill is that difference between purchase consideration paid and fair value of net asset acquired. So in this case, when we talk about purchase consideration, it is obvious that if a company, for instance, company A here, is to acquire majority of the shares in company B, company A is expected to pay for those shares acquired. So that amount of money which has been paid by company A as a result of acquiring majority of the shares in company B is what we refer as purchase what? Consideration. So therefore, we take the purchase consideration which was paid by the parent company in acquiring majority of the shares in company B, and then you less the net asset which were acquired. The difference is now what you are referring to as what? Goodwill. Now what you are saying is that IFRS 3 then do what? Establishes the procedures to be used by the parent company in terms of doing what? Measuring that goodwill. Now, according to this standard, we have two methods which the parent company can use to determine the goodwill arising from business what? Combination. So therefore, we can proceed and look on the methods of determining the goodwill. Methods of determining goodwill. Methods of determining goodwill which arises from business combination. Business combination. We have two methods. The first method is called the full goodwill method. The full goodwill method. And number two, we have the partial goodwill method. Partial goodwill method. So let's start with the first method here, and that is a full goodwill method. So we start with number one, full goodwill method. Now, under this particular method here, or the parent company, or the goodwill which is determined is the goodwill which is attributable to the parent company and the goodwill attributable to the NCI. So what do you mean by that? Let's assume we have or we are given some information by the examiner, and you're told company A acquired 80% of the ordinary shares issued by company B. What this means is that company A here will be our parent company, whereas company B is a subsidiary. And company A, you can see, acquired 80% of the shares issued by company B. What happens then, or who hold the remaining 20% of the shares issued by company B? The remaining 20% of the shares issued by company B, these shares we have said they are held by who? NCI, minority shareholders. So therefore we are saying under the full goodwill method, we determine the goodwill arising, or the goodwill attributable to the parent company, and the goodwill attributable to who? To the non-controlling interest. So we can say under this method, the goodwill computed, or in other terms determined, is attributable to both parent entity or parent company and the non-controlling interest. So the goodwill which is determined here, we are saying that goodwill is the goodwill of the parent company and the goodwill of what? The non-controlling interest. So let's look on how we determine the goodwill using the full goodwill method. So the goodwill on business combination. So business combination is just the same with the business, or is the same with acquisition. So this can also be referred to as a goodwill arising on acquisition. That is the other term the examiner can be able to use. You may be required to compute the goodwill arising from acquisition. Acquisition of company B by, for example, company what? Company A here. So in terms of how we compute this goodwill using now the full goodwill method, So generally you should have two columns here. So always we start by recording the cost of investment. the cost of investment. What is the cost of investment? Cost of investment is the same with the purchase consideration paid by the parent company. So how much amount did our parent company paid here in acquiring majority of the shares, in acquiring 80% of the shares in B? We refer to that as purchase consideration or the cost of investment. So under the full goodwill method, to this there is something we come here and we add, and that is something called the NCI at fair value. So what is the NCI at fair value? NCI at fair value, this refers to the amount of money which was paid by the minority shareholders when acquiring 20% of their shares in this subsidiary. So therefore you can say that this is purchase consideration, a purchase consideration, a consideration paid by NCI. Paid by NCI, who are the minority shareholders. So in most of the questions, you'll be given this figure. You'll be given the NCI at fair value. You'll be given the purchase consideration which was paid by minority shareholders in acquiring their shares. But in the event that purchase consideration is not given, the purchase consideration paid by the minority shareholders, there is how you determine that. One, you have to compute the shares acquired by minority shareholders in the subsidiary. So first of all, determine, or we are saying in computing the NCI at fair value, if this is not given, how do we compute that? Take the shares acquired, or basically we can talk of shares held by NCI in the subsidiary company, of which the computation of that is quite simple, because if you are told this company here had issued, for example, like 1 million shares, so it means that this company acquired 80% of those shares. 80% is 800,000. It means that the shares held or acquired by minority shareholders will be 20% of the shares issued by the subsidiary. That is how we compute the shares held by minority shareholders in the subsidiary, and then multiply those shares with their fair value. The fair value is the same with what? The market price per share. The market price per share on the date of acquisition. The date of acquisition, that one is abbreviated as DOA. DOA is the date the parent company acquired 80% of the shares in the subsidiary, and equally the date when the minority shareholders acquired their shares in the subsidiary. So therefore we have said you do what? You take the shares which were acquired by the minority shareholders, multiply those shares with their fair value or market price per share on the date of acquisition. In some cases, the examiner may not have given you this figure. You have to compute it. That is how we compute what? The NCI at fair value. So then add the two values there. After adding the two values, we proceed and we less the fair value of net assets acquired, fair value of net assets acquired, fair value of net asset acquired. Equally, this fair value of the net asset acquired will not be given. You have to determine that. So let's look on how we determine the fair value of a net asset acquired. So to determine the fair value of this company net asset on the date of acquisition, what we do, we take the subsidiary company ordinary share capital, and then to this we add the pre-acquisition reserves. So the pre-acquisition reserves, we are referring to the reserves the subsidiary company was having at the date of acquisition. The reserves include things like revaluation reserve, the retained earnings, the shareholder premium. So add all of them, and whatever you get will be the net asset of this company, the net asset of the subsidiary on the date of acquisition. And in our case, because we are interested with the fair value of the net asset acquired by both the parent and also the NCI, so what you do, you take 100% of this. Take 100% of this, 100% of this, because in our case we are interested with the net asset acquired by the parent and also by the subsidiary. And then what you do, you less that from the total figure which we have there. So here you can get a positive figure. In some cases, you can get a negative what? Figure. So if you get a positive figure, that is goodwill on acquisition, and this particular goodwill here will be taken to the consolidated statement of financial position as a component of non-current asset. Goodwill is an asset. But if you get a negative figure here, we refer to that as a gain on bargain purchase, a gain on bargain purchase, and this one should be recognized as part of other incomes, in the consolidated income statement. Consolidated income statement is now the income statement which will be prepared by the parent company, which has acquired that particular what? Subsidiary. So therefore, that's how we compute now the goodwill arising on business acquisition, the goodwill arising from acquisition, using which method? The full goodwill method. But in most of the questions, or basically in an exam setup, mostly the examiner will not tell you which method to use. In most of the cases, if the examiner is requiring you to use the full goodwill method, you'll come across a statement whereby you're told it is the policy of the group to measure the NCI at fair value. And in most of the cases, what the examiner will have done, he will have given you this value, the NCI at fair value. If you are not given the NCI at fair value, the examiner will have given you the fair value or the market price of the subsidiary company shares on the date of acquisition. On the date of what? Acquisition. So therefore, you can put that here as a note. We can put here that here as a note that under the full goodwill method, or we can just say that in an example, what the examiner will tell you that it is the policy. It is the policy of the group to measure NCI at fair or full value, and we have said mostly the examiner will go ahead and he will give you the NCI at a fair value. That value will be given to you. So if you come across such a statement, that is the policy of the group to measure NCI at fair or full value, and the examiner has gone further to give you the NCI at fair value, automatically you have to use which method? The full goodwill method. Let's look on the other method of computing the goodwill arising from business combination or arising from acquisition. That is the partial goodwill method. So under this particular method here, the partial goodwill method, the goodwill determined is the goodwill attributable to the parent company only. So we can say under this method, the goodwill determined is attributable to the parent company only. Attributable to the parent company only. So mean that the goodwill which we determine using the partial goodwill method does not include the goodwill attributable to, or does not include the goodwill of NCI, does not include the goodwill of minority shareholder. So how do we compute that goodwill arising from business combination or arising on acquisition using now the partial goodwill method? So always we start with the purchase consideration which was paid. And this is the purchase consideration which was paid by the parent entity or the parent company. And then to this you proceed and you less the fair value of net assets acquired by parent entity only. By parent entity only. By parent entity only. So remember in this case, we have said that in almost all questions for group account, the examiner will not have given you the fair value of the net asset of this subsidiary on the date of acquisition. You have to compute that. You have to determine what was the fair value of the subsidiary company net asset on the date of acquisition. I've said to do that, you take the subsidiary company ordinary share capital plus all pre-acquisition reserves. Pre-acquisition reserves, you have said, are the reserves the subsidiary company was having at the date it was acquired by the parent. At the date it was acquired by the parent. That is something which the examiner will have clearly specified. What is the retained earnings of the subsidiary on the date it was acquired? What was its share premium and other reserves on that word? Date. So in this case, because we are only interested with the net asset acquired by the parent, if the parent company acquired 80% of the shares in the subsidiary, it means that the parent company equally acquired net asset equal to 80%. So that is now the rate which you come and you apply here. You have to multiply or to apply the parent company or this particular rate here. For example, if the parent company acquired 80% of the shares, you compute the fair value of the net asset of the subsidiary company on the date of acquisition times 80%. Times 80%. And then you get the difference, which will be a goodwill if a positive figure. And if a negative, I've said we refer to that as a gain on bargain purchase. A gain on bargain what? Purchase. So therefore we have those as the two methods which are given by IFRS 3 and which the parent company may use in terms of computing what? The goodwill. But equally, if the examiner or if the group is using the partial goodwill method, the examiner will not have given you that information that the group is using the partial. But what the examiner will do, he will give you a statement. He will give you a statement whereby you are told it is a policy of the group. It is the policy of the group to measure. It is the policy of the group to do what? To measure NCI at the proportionate share of net assets. Proportionate share of net assets. So if you come across such a statement in any question for group account, what by the end of the day that means that you compute the goodwill using the partial goodwill method. Partial goodwill method. And in such a case, now the examiner will not have given you the NCI at fair value. The NCI at fair what? Value. So therefore, those are the two methods which may be used by the parent company here to compute the goodwill arising from a business combination or arising from the parent company acquiring what? A subsidiary. So that is the first standard you need to know, or that is the first thing you need to know as far as a group account is concerned. And in any question you come across for group account, always you have to compute the goodwill, because we are saying this goodwill is an asset in the statement of financial position, or in some cases the examiner may have allocated some marks as far as the computation of goodwill is concerned. So therefore you have to know how do we compute this goodwill arising from business a combination. Then from there we can proceed and we look on something else as far as the group account is concerned, as far as the preparation of group accounts are concerned, and that is something to do with the forms of purchase consideration, forms of purchase consideration, forms of purchase consideration. Remember, we have said purchase consideration is that amount of money which is paid by the parent company in acquiring majority of the shares in a subsidiary. Once a parent company here acquires a subsidiary company, automatically you have said that the parent company is expected to pay for the majority of the shares acquired in what? In that subsidiary. Now, this purchase consideration paid by the parent entity, paid by the parent company, may take various forms, One of it is the cash consideration, consideration. And for the cash consideration, this whereby the parent company paid the purchase consideration on cash, and also that consideration was paid on the date of acquisition. On the date of what? Acquisition. So we can say purchase consideration here, purchase consideration was in cash, and also it was paid on the date of acquisition. So this date of acquisition, we abbreviate that as DOA. DOA, the date of acquisition. This is the date the parent company acquired majority of the shares in the subsidiary. And this particular purchase consideration, which was paid in cash, do not have any special treatment when it comes to the computation of goodwill. When computing the goodwill, or basically that cash consideration, you take it the way it is given. It is what? Given. So we can say it has no special treatment. No special treatment. So use the amount the way it is given. Use the amount the way it is what? Given. So the other form of purchase consideration number 2 is a deferred consideration. A deferred consideration. When talk about a deferred consideration, this is a consideration which the parent company is to pay on a future date. So mean that we may be told that the parent company acquired a subsidiary on 1st of January. Acquired a subsidiary on 1st of January 2023, but this company has promised to pay some cash or some additional consideration or additional cash, maybe on 31st of December 2025. So these are consideration to be paid on a future date. And because it forms part of the consideration which the parent company is expected to pay, it must be used in the computation of what? Of goodwill. So therefore, how do we deal with this particular deferred consideration? So this deferred consideration, we can say it is discounted. It is discounted to its present value. Using parent company cost of capital. We discount it, we get its present value using the parent company cost of capital. The parent company cost of capital. So the other form of consideration, the other form which the purchase consideration may take is share exchange consideration. Share exchange consideration. Share exchange consideration. Share exchange consideration basically is a consideration which is paid by the parent company by issuing its own shares. So the parent company has acquired the majority of the shares in the subsidiary, but the parent company will not pay the shares acquired in this company in cash, but rather the parent company will issue its own shares as a form of payment. Actually, in all questions whereby the parent company has paid the purchase consideration by issuing its own shares, you'll be told that the parent company had not determined and also accounted for that purchase consideration, because there is something which the examiner here will be testing, whether you are in a position to compute this purchase consideration, and also do you know how that purchase consideration is accounted for. So therefore, whenever the purchase consideration has been paid by the parent company issuing its own shares, how do we determine that purchase consideration? So the purchase consideration paid through share exchange is computed by 1, determining the number of shares issued by parent company. How many shares did the parent company issue to pay the purchase consideration? And then you proceed and you multiply those particular shares with their fair value or market price on the date of acquisition. The date of what? Acquisition. You have to determine the shares which were issued by the parent company and to pay the purchase consideration, and then you proceed, you multiply those particular shares with their fair value or market price on the date of acquisition. Equally, it is important for you to know how should that purchase consideration be accounted for. So we can look on the accounting entries for the purchase consideration which is paid through share exchange. So that amount of purchase consideration paid through share exchange is debited in the account called cost of investment. So when computing the goodwill arising from business combination, that is the figure you're going to use as your cost of investment or as your purchase consideration. And then because the parent company issued its own shares to pay the purchase consideration, and in this case I've said the examiner will have given you some information that that purchase consideration was not accounted for by the parent. So what you do, you credit the parent company ordinary share capital, credit parent company ordinary share capital, and the amount which you credit in this account is always based on the par value of each share. Based on the par value of each share, if the shares happens to have been issued at a market price which is higher than the par value, the amount which is above the par value is what? Is a share premium. Is a share what? Is a share premium. So therefore, that's how we compute. We compute and also account for the purchase consideration which was paid through what? Through share exchange. So therefore, the amount of purchase consideration paid by the parent company after acquiring a control, after acquiring majority of the shares in the subsidiary, may take any of those forms. It can be a cash consideration which you're saying do not have any special treatment. You just use it in computing your goodwill the way it is given. A deferred consideration, a consideration to be paid by the parent company in future. We are saying for when computing the goodwill arising on acquisition, what you do, you have to discount it. You have to get its present value using the parent company cost of what? Capital. And then we have a purchase consideration which may take the form of a share exchange. And we have said this whereby the parent company issued its own shares to pay the purchase what? Consideration. When the parent company acquire majority of the shares in the subsidiary, the parent company will not pay for them in cash, but the parent company will issue its own what? Shares. Its own what? Shares. So how do we compute that purchase consideration? Take into account, compute the number of shares issued by the parent company, multiply those shares with the fair value or the market price per share on the date of acquisition, and then go ahead and account for that purchase consideration in that what? From debit the cost of investment, and then you credit the parent company ordinary share capital, and then you do what? You also credit the share what? The share premium. So therefore, that first of all, what you need to know. I want us to take a break, and then once we come back in our next session, we are going to look on how the group accounts are prepared whenever the parent company has made an investment in what? In a subsidiary.
Hello learner, welcome to Manifested E-Learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A, you can see the average right over here. And the average of what? We want to pick the average for Z term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the brackets, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi all share index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with co-assemblers corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this, we divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay, like that, because that's just the covariance, like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. There, that's our beta, 0.0932. And if you are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Greetings, candidates, and welcome back to the financial reporting and analysis lesson. The topic is public sector accounting standards. We are proceeding with the study of the international public sector accounting standards. Today, our focus is on provisions, contingent liabilities, and contingent assets. This is IPSAS number 19. IPSAS number 19. IPSAS number 19. This standard deals with provisions, contingent liabilities, and contingent assets. In our today's lesson, I'm going to define provisions. We'll also define contingent liabilities as well as contingent assets. And in defining these three, we also give examples of the provisions, contingent liabilities, and contingent assets. We'll go ahead and study the provisions of the standard in regard to recognition, measurement, and disclosure of provisions, contingent liabilities, and contingent assets. In other words, we are going to study what IPSAS number 19 says in regard to how to recognize provisions and contingent liabilities and contingent assets, how to measure these three, and how the three should be disclosed in the financial statements of the public sector entities. And candidates, IPSAS 19 refers to the International Public Sector Accounting Standard number 19, which focuses on provisions, contingent liabilities, and contingent assets. This standard outlines the accounting treatment for provisions, accounting treatment for accounting liabilities, and accounting treatment for contingent assets. Do you understand? It provides guidelines on recognizing, measuring, and also disclosing these items in the financial statements to ensure transparency and accuracy in the reporting for public sector entities. And the standard aims to assist governments and other public sector entities in presenting financial information that reflects the economic reality of their situation, including potential obligations and assets that might arise from uncertain situations, including potential obligations, including potential assets that arise from uncertain events. So we'll begin with provisions. We are going to begin with provisions. What are, firstly, provisions? It's important for us, first of all, to understand what are provisions. Now, candidates, a provision in accounting terms is a liability of uncertain timing or amount. I repeat, a provision is a liability of uncertain timing and amount. It is a liability of uncertain. It is a, first of all, a liability. It is a liability of uncertain timing and amount. That means that the timing and the amount of this liability is not known. It is uncertain. It is an amount set aside to cover for a probable future expense or loss. It is what? It is an amount that is set aside to cover a probable future expense or loss. And provisions candidates are recognized on the balance sheet and are matched to an appropriate expense account on the income statement. I'll give examples of provisions. One is warranty expenses. Warranty expenses. Now, a provision for warranty expense is set up to cover the estimated cost of future warranty claims. Bad debt expenses. Bad debt expenses. Also a provision for bad debt expenses that is set up to cover the estimated amount of uncollectible amounts recoverable. The third example, litigation expenses. Litigation expenses is also an example of a provision. This is a provision for litigation expenses that is set up to cover the estimated cost of defending against or settling pending lawsuits. Litigation expenses. Restructuring costs. Restructuring costs. Restructuring costs. A provision for restructuring costs is also set up, can also be set up to cover the estimated cost of a business restructuring, such as asset impairments, and so on, restructuring costs. Number 5, the fifth example of a provision could be what we call environmental remediation costs. Environmental remediation cost is a provision for environmental remediation costs that is set up to cover the estimated cost of cleaning up environmental contamination cost by the entity. Environmental remediation costs. So these are 5 examples of provision. Now we're going to now consider or look at the accounting treatment. Accounting treatment. First of all, we look at recognition. How are provisions recognized? Recognition. How should a provision be recognized by public entities? That is the question. Recognition. Now, a provision is recognized when it is recognized when the entity has a legal or constructive obligations as a result of past events. Legal obligation. A provision can only be recognized in the financial statements of a public sector entity if it has a legal obligation. If the entity has a legal or constructive obligation as a result of past events. 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 That is the first condition for recognizing a provision. All right? Legal obligation. Number 2, a provision is recognized only if it is probable. Only if it is probable. Only if there is a chance that an outflow of resources will be required to settle the obligation. Only if it is probable. It is probable that there will be an outflow. This is an outflow of resources. Probable that there will be an outflow. Outflow of resources. If it is probable that there will be an outflow of resources to settle the obligation. Firstly, there ought to be a legal obligation. Secondly, there has to be chance. There has to be a probability that there will be an outflow of resources to settle the obligation. Then the third condition for recognizing a provision is if the amount of the obligation can be estimated reliably. Estimated reliably. If this amount that is to to be paid can be estimated reliably. So these are three conditions for recognizing a provision. Do you understand? We have defined what a provision is. We've given examples of provisions. Then we have outlined the conditions for recognizing provision. Then we need to look at how are provisions measured. Measurement of provisions. Measurement of provision. This is recognition. Number two, measurement. How are provisions measured? What does the standard say in regard to measurement of provisions? Provisions are measured at the present value of the amount expected to be required to settle the obligations. Provisions are measured at the present value. Provisions are measured at the present value. Are measured at the present value of the amount expected. All right? Are measured at the present value of the amount expected to be paid. You said here, if it is probable that there will be an outflow. If an outflow is expected in future, if an outflow is expected, then this expectation is in future. But when recognizing, when measuring, this is recognition, it is expected that a provision may be paid in future. That is future value. But when measuring this provision, then the measurement must be at the present value of the amount expected. So, for example, if the amount is expected to be 100 million in 2 years, then this amount has to be discounted in order to determine the present value of the provision. So measurement of provisions in the books of public sector entities has to be at the present value. It has to be at the present value of the amount expected to be required to settle the obligations. Measurement is at the present value. That is after discounting the future value to get the present value using a certain present value interest factor. Present value interest factor. That is how provisions are measured. How about disclosure? Disclosure. How are provisions to be disclosed? Disclosure. Now, public sector entities are required to disclose certain information about provisions in the notes to the financial statements. Firstly, this disclosure has to be made in the notes to the financial statements. Disclosure is made in the notes to the financial statements of the public sector entity. And what exactly is to be disclosed? One is the nature of obligations. A, nature of the obligation. What is the nature of the obligation? What is the amount of the provision? Amount of the provision has to be disclosed in the notes to the financial statements. The amount of the obligation or provision. The amount of the provision. The amount of the provision. Then there ought to be the method used to measure the provision. Method used to measure has to be disclosed. Method used to measure the provision. What method has to be used? Was used? What method was used to measure the provision? That has to be disclosed to the in the notes to the financial statements of a public sector entity. The method used. Then D is any significant changes in the provision during the period. Any significant change made to the provision during the period. Any significant change made to the provision during the provision. This also ought to be disclosed in the notes to the financial statements of a public sector entity. Do you understand? We've discussed the accounting treatment of provisions in the books of public sector entities. These are provisions. The standard is number 19. All right, we've described how these provisions are recognized, how they are measured, and disclosure. Let us now proceed with contingent liabilities. We've studied provisions. We are moving on to contingent liabilities. Contingent liabilities. Contingent liabilities. Contingent liabilities. What is a contingent liability? Now, a contingent liability is a potential liability that may or may not occur. It is a potential liability that may or may not occur. Potential means probable, okay? Expected liability that may occur or may not occur. And this occurrence or non-occurrence is dependent on the outcome of an uncertain future event. All right? The occurrence or the non-occurrence of these contingent liabilities is dependent on an outcome of an event that is uncertain in future. We'll give examples of such liabilities. Examples of contingent liabilities. Give one example. One is that a good example is where a company sells a product with a 1-year warranty, and if the product breaks down within 1 year of purchase, the company is obligated to repair or replace it. So that means that the company has a contingent liability for warranty expenses because it is possible that some of its products will break down within the warranty period, and the company will have to incur costs to repair or replace them. So the company should disclose the contingent liability for warranty expenses in the notes to the financial statements. most of you or some of you may have bought maybe assets, home refrigerators or sound systems that come with the warranty. And when purchasing, you are required to sign a warranty contract with the buyer or the seller. So if you are to buy such an item from, say, a supermarket, and the supermarket gives you a warranty, a period of 1 year, and when that happens, the supermarket is obligated to repair or replace that item, and therefore the supermarket is required to have a contingent liability for warranty expenses, because it's possible that some of its products will break down within the warranty period, and the supermarket will have to incur costs to repair such items, and therefore the company should disclose the contingent liability for warranty expenses in the notes to the financial statement. That's an example of contingent liability. And we've defined contingent liability as a potential liability that may occur or may not occur. And we say that the occurrence or non-occurrence of this liability is dependent on a future event that is not certain. In the example I've just given, it could be possible that, or not possible, it could be the item that is bought may get damaged or may not get damaged, and the standard gives requirements, key requirements, when accounting for contingent liabilities. And these are the requirements we are now moving on to study. How are contingent liabilities, first of all, recognized in the financial statements? Recognition. Recognition. Now, a contingent liability is recognized when when a certain criteria is met. For a liability to be included in the financial statement as a contingent liability, then there is a criteria that has to be met. And what is this criteria? Number one is that the entity should have a possible obligation as a result of the past event. Possible obligation. The entity must have a possible obligation. Possible obligation as a result of a past event. Number two, the second criteria is the obligation should be contingent. The obligation should be contingent on the occurrence or non-occurrence of one or more uncertain future events. It must be contingent. Remember, we say that the occurrence or non-occurrence happens depending on an outcome of uncertain future event. So the second criteria here is that the obligation should be contingent on the occurrence. Contingent on the occurrence or non-occurrence of a future event, occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. That is, not wholly within the control, not wholly within the control of the entity. For example, the breaking of an item is not within the control of the seller. That one is within the control of the one who bought the item. So that's the second criteria. The third criteria is that it is probable that an outflow of resources will be required to settle the obligations. It is probable. It is probable. That means there is a probability. It is probable that an outflow of resources there is a probability of an outflow of resources that will be required to settle the obligation. This is the criteria for recognizing contingent liabilities. What of the measurement? What does the standard say in relation to measurement of contingent liabilities? Now, contingent liabilities are not measured. Contingent liabilities, it's important to note that contingent liabilities are not measured, but they are simply disclosed. They are not measured, but disclosed. They are not measured, but they are disclosed. They are not measured, but they are disclosed in the notes to the financial statement. Are not measured, but disclosed in the notes to the financial statements. So it's important for an entity to reveal, to disclose in the financial statements the contingent liabilities. Disclosure. What are disclosure requirements for contingent liabilities? Now, public sector entities are required to disclose certain information about contingent liabilities in the notes to the financial statements. One information that is required is the nature of contingent liabilities. What is the nature of the contingent liability? That has to be disclosed to the notes, in the notes to the financial statements. Nature of contingent liabilities. Then there ought to be a description. The entity has to give a description of the uncertain future events on which the obligation depends. Description of future events. There should be a description of future events on which the obligation or liability depends. Remember, we say that a contingent liability is a potential liability that may or may not occur. And the occurrence or non-occurrence of such a liability is dependent on uncertain future event. So when disclosing contingent liabilities, then there ought to be a description of future events on which the obligation or the liability depends. Number 3, third point is an estimate of financial effect. An estimate of financial effect of the contingent liability. An estimate of the financial effect of a contingent liability if practicable. Now, the disclosure of contingent liabilities is important, candidates, and therefore there ought to be an estimate. So these are three categories or kinds of information that has to be disclosed in the notes to the financial statements of a public sector entity in regards to the contingent liabilities. When disclosing, first of all, we've said that contingent liabilities are not measured, but they are disclosed in the notes to the financial statements. And when disclosing these contingent liabilities in the notes to the financial statement, then the entity should clearly give information on the nature of contingent liabilities, number one. Number two, there ought to be a description of future events on which the obligation depends. Number three, there ought to be an estimate of a financial effect of the contingent liability if practicable. So this information is important. And you can see the importance of having this information included as part of information that the public sector entity provides to the users. This disclosure of contingent liabilities, candidates, is important because it allows users of financial statements to assess the entity's financial risks and also to make informed decisions about whether or not to invest or lend money to the entity. And therefore, as much as contingent liabilities are not measured, they ought to be disclosed because this disclosure aids the users to make informed decisions. And candidates, contingent liabilities can be a significant financial risk for public sector entities. And therefore, public sector entities should carefully manage their contingent liabilities. They should also disclose them in the financial statements in accordance with International Public Sector Accounting Standard number 9. Now, having discussed the key requirements for contingent liabilities, we will move on to the next aspect of International Public Sector Accounting Standard number 9, which is contingent assets. Contingent